All right, welcome everybody to this evening's event. My name is Don Kaufman. I'm going to be your host here for approximately the next two and a half hours. If you're on the East Coast over there, we're going to keep you up a little bit late, right? There's some basketball on. You can watch that in the background. I'm completely understanding, and I'm fairly sure that everybody in our Austin office is involved in some type of a pool and watching basketball as well. Many of the games are already over, though. So, again, welcome everybody. We'll get started a little slowly. I know that quite a few of you are just now entering the room, may or may not know me, so I'll give you a little background maybe on myself as I do kind of jump into things. We'll have plenty of time tonight to not only go through this presentation, but I want to be able to, of course, answer a number of questions as we go along as well too. And I'll stay here, much to all the staff in our Austin office. That's, of course, they've been there. We've been doing an open house the last 2 days, so some of the people in our Austin office, they're on about their 13th or 14th hour. What's the point? We'll just keep them there overnight. So we'll let's kind of get into this a little bit here. Again, my name is Don Kaufman. I only recently joined Simpler Trading, and I've actually known John Carter for many years. We actually met in a head-to-head trading competition, and this is years and years ago. So I've again known of John, been friends with him on and off for years. Saw him at different trade shows and so forth, and it was actually like a really nice kind of natural progression for me to kind of head into John's organization. And what I'm now doing in John's organization is we have a number of different individuals that do these presentations, from John and myself to Bruce to Henry and on, and Neil and Tony. In any regard, I'm ultimately trying to make a little bit of more of a cohesive bunch and so forth, and really enjoyed it. Been here a whopping 7 weeks. This is really my first full-blown class that I'm going in solo. So I will give you a little background on myself and how I got started, because I think that's important. Now, some people, who's this guy? Okay, I originally started trading at age 22. I had been around trading most of my life. Very few people know my background. I come from like a family of traders. My uncle, all the way back in the 1970s, he actually started a trading firm. And that's not really how I got involved in this business, but it definitely piqued my interest. As a kid kind of growing up, I'd spend time in Chicago. I was originally from New York, and I would go down to the trading floor and had been there numerous times, so I knew what it was about. Right out of college, I got an offer, and shortly thereafter, I ended up as a clerk on the trading floor. And a clerk it's like a glorified gopher. So that was 3 weeks out of college, and if you put a kid that's 22 years old down on a trading floor, I don't think he's likely to leave. I never had a degree in finance. I did a degree in molecular genetics. That and about $5 will probably buy me a cup of Starbucks. But again, I really, loved the business and so forth. Anyway, I was down clerking on the floor, and only a very short time after that, about 3 weeks after that, guy didn't show up for work. Apparently was a little too hungover to show up to work. And I guess like any, good opportunity, you pretty much had to like seize the opportunity. I showed up to work one day and they said, "You're on a seat. You want to trade?" I said, "I have no clue as to what I'm doing." They go, "Neither did any of us." And, all of a sudden here I am, some 17 years later. So I'm going to turn the ripe old age of 39 next week. Again, I've been trading, officially trading since about 22. And only shortly after trading in Chicago, they moved me upstairs as a risk manager, primarily because I'm 5'8" and about 175 pounds in a good day. So I stood right next to a guy, still really close friends with him, that's 6'5" and about 280. It's again a little bit of a different business. So they moved me upstairs as a risk manager, and I was really one of the first quote-unquote screen-based traders. And that's really what I did as a derivatives risk manager for the next 2 years. And then at the ripe old age of 24, I knew a couple of guys on the trading floor. They had approached me, kind of pulled me aside and said, "Listen, kid, You don't know any better. You're a pretty sharp little monkey. Why don't you come? Why don't you join us? We're starting a brokerage firm. And hey, you can travel around. We'll even give you an expense account. You don't even have to live in Chicago. And so I had family that lived out in Scottsdale, Arizona. That's where I've been really ever since. And at that time, I actually joined what was a startup firm called Thinkorswim. And when we first started Thinkorswim, it was such a small firm. We had to trade to survive. Like, it wasn't like a big salary coming out of there. I was 24 years old. I would have basically taken, next to nothing, which is pretty much what I did. And it was like a true startup firm. We were hiring people left and right, kids pretty much off the street, that were working at Starbucks that at the time, it was in 2001, the tech bubble had crashed. We hired a couple of people from Starbucks that happened to be from the tech industry that couldn't get jobs anywhere. And, lo and behold, again, here I am kind of about 15 years in the brokerage industry. I went through all the different acquisitions and private equity firms. And so I've been through a number of different things. And really the last 5-6 years, I've actually, run a group inside of TD Ameritrade. And, I liked the phrase that we use here, taking the muzzle off. When you work inside of a brokerage firm, you can't even talk about like ETFs. And I'm going to try to, unleash the beast upon you. One of the other things is, I would do presentations every single day on Thinkorswim. Okay, they're still archived on Thinkorswim. But one of the things that I was never able to do is, I couldn't actually say like, this is what I do in my trade. Like I was never capable of turning around and saying like, hey, I use, and I'm going to show you tonight, like in an iron Condor, I use an 8 delta call, which then tells me which put to use. And I'm going to get into really finite criteria. I learned early on in my trading career that it wasn't about like, trading's not like about a feel of a marketplace. The ones that were like the most consistent were often the ones that were the most effective. And it was taught to me really early on that, hey, Don, you're going to develop a very rigid set of criteria. And it's just something like I've traded that way my entire career. Like I don't make split-second decisions as this is going up, this is going down. Sure, you're forced to make decisions as things happen, but ultimately you still have to follow, some very definitive methodology. And what I'm going to try to do tonight is give you a little bit of that recipe. And tonight's presentation is really kind of broken up into 3 major parts. Okay, and there's a 4th part that's a little bit of an add-on over there. And the first part that I'm really going to start to cover this evening is going to be about volatility. But to throw out kind of a couple of really key ideas over here, learning to really be effective, or what I call thrive in volatile markets. The markets have not been volatile the last few years. The last time we really saw a bout of volatility, of true volatility, has been since 2011. That's the last time volatility, piqued anybody's interest. Here we are sitting in 2015. Everybody's like, oh, it's going to be okay. Everything's going to be okay. Every sign is in front of us that volatility is coming, and nobody wants to read that. So there's not much like I can tell you definitively about a future of a marketplace. Those that tell you, I know where it's going, 6 months from now, you have no idea. The only thing that I can tell you quite definitively is that more volatility is coming. Interest rates are going to impact volatility of the marketplace. And there's really no if, and, or but about it. We're already seeing it, and that's exactly what I'm going to try to describe a little bit to you. By the way, everybody keeps asking about my slides. We will absolutely be able to provide all of the slides to you because that's really what I wanted. Like, I've never been able to say like, hey, this is the kind of criteria I use, and then like, here's my slide. So we're going to, initially, in like part 1 over here, we're going to talk about just volatile markets. We're going to talk about coping with increased volatility. Then we're going to talk about iron condors. They're actually like really 2 different parts of the equation. So part of this volatility discussion, this is outside you ever even trading an iron condor. This should impact everything you do in markets, period. is understanding and coping with volatility. And I thought to myself, I go, I'm not doing a class just about iron condors. Like, I'm doing a class, I have to talk about the onset of volatility that's forthcoming. Then we are going to talk about specific entry and exit criteria. We're going to talk about building an inventory of iron condors. And I'm very adamant about this. Another huge portion of being successful, not just in any market, but success in a market, you're going to have to learn to strategically place trades. Okay? Understanding an iron condor doesn't necessarily make you money. It doesn't. Like, I mean, you can go out right now and you can Google, this is an iron condor, and Google's going to tell you what an iron condor is. The Investopedia is going to tell you what an iron condor is. You know, that's not going to do it. You got to get in entry and exit criteria, but more specifically, there has to be more to that, right? And allocation is the big underdog. Like, nobody ever talks about allocation. I have been to pretty much everything out there, and very few people say, like, hey, this is the amount that you might want to allocate. And I'm going to go beyond that. Okay? I'm going to go much beyond that. I'm actually going to show you how to break capital up into unique, trades. And by doing that, it circumnavigates the idea, like, if markets just completely fall out of bed on you, okay, you can't take one big hit and be reset. And so many of you listening right now, you're probably like, oh crap, I've been there before, right? You made money. Bam, you got hit by a train. You saw the train coming. You just couldn't get out of the way fast enough. And a lot of that has to do with allocation and allocation techniques. Okay? So with that, I always throw this in there too. Embrace the horror. It's kind of like, one of my catchphrases. I've made my own career in trading. I've made it around volatility. Okay? And I make no two ways about this. Okay? I wouldn't say that I'm a bear, because, I just enjoy when the markets are on fire, okay? People are flipping out. It is the most effective time to trade, because the increased volatility, the bottom line is you can just sell premium in markets, okay, at inflated levels. And as long as you know how to manage that risk, you're going to be all right. Okay, and even now, when you're kind of thinking like volatility is not huge right now, but we're still in a much better volatility situation right here, right now, than we were even 6 months ago. This past October, we saw a little bit of volatility, piqued some interest out there. So with that, let's kind of continue on over there. House Monkey is in here tonight too. All right, so part one over here is getting to know volatility. First thing I got to talk about, and I've had this conversation over the years, on the Thinkorswim platform. I've talked about this so many times. I've never really put a PowerPoint presentation together for it, so here it is. Okay, when we talk about volatility, there's really actually two types of volatility. You have what they call implied volatility, and you have historical volatility. They're both, important. Historical volatility is the annualized standard deviation of the past stock price movement. I swear to you, I'm not even reading it off the slide over here. The bottom line is historical volatility. It's actual movement, okay, in a stock or an index. It's important to just understand that that's just actual movement. When you're trading options, okay, and many of you may be brand new to options, you actually talk about implied volatility. Implied volatility, that's what prices options. Okay, now with this idea, you're thinking, oh man, volatility. Lots of people talk about something called the VIX. Now, throughout the course of the evening, I will go back and forth. I am going to use the Thinkorswim trading application. And why? I'm on TradeStation. It's okay. Deep breaths, okay? I'm not going to use full brunt of functionality on Thinkorswim and make this a Thinkorswim demo. Been there, done that for 15 years, okay? I am intimately familiar with the Thinkorswim platform, but I've kind of over the last 6 weeks, I'm like, I don't care who you trade with, fire at will. I am nuts though about one thing. When you trade, okay, whoever you trade with, I'm begging you, whatever your commission schedule is, if you trade options, and we are going to talk about options tonight, that's what an iron condor is all about. Get a commission structure, okay, that's a per contract basis with no ticket charge. Okay? And I'm not telling you that because I worked in the brokerage industry. I'm telling you that because when you trade, you don't want to have to be a big trader. You want to be able to probe markets. What that basically means is I want you to be able to trade one contract. And when you have like one contract, people pay like, $7 plus 75 cents a contract. It kills you. Okay? We're $10 plus 75 cents or $10 plus 50 cents, or another firm's got $4 minimums plus this amount. Come on, just pay like $1.50 a contract. That's the deal that we have through TD Ameritrade. I know that. Okay? I know TradeStation's got a pretty good deal through simpler options, but I'm just saying a per contract fee is just way better because you want to be able to scale positions in and scale positions out. And that's one side of the brokerage industry like nobody ever let me talk about, which I love saying that kind of stuff. Like, forget the $10 minimum. Make a fortune off that crap, okay, per contract fee. Because that way you can just say one lot, one lot, one lot, one lot. No reason to go, I have to do 10 or I have to do 20 over there. By the way, some people, different commission structures over there. Again, the one I know we've got over here. So there's some firms that are cheaper, some firms that are more expensive. All right. Anyway, per contract fee, I feel really strongly about that. So call your brokerage firm. Don't tell them I said anything. Okay. Especially if you're Canadian over there, they're going to hunt me down and find me over there. Anyway, so that's just one key thing. So when we talk about volatility, lots of people think about the VIX and so forth. And when you go to a trade tab, okay, I'm looking at the SPX, but it doesn't matter. Let's look at another stock. Hey, hell, let's look at Microsoft. So here's Microsoft. In Microsoft, okay, you look at this is an option chain down below. And there's 8 days and 14 days and 22 days. You look to the far right-hand side of the screen, and there's this number. It says like 17% or 18% or 23%. Well, that's the implied volatility, okay? And what that implied volatility really is, okay, it justifies an option's current market price. You're like, yeah, whatever. The volatility is really what prices options, okay? But the volatility does much more than that. So let me give you an example, okay? We have a stock, and the stock is trading right smack at $100. And this is the easiest way to explain volatility because, like, when people look at volatility in these numbers, they're so esoteric. It's like, oh, yeah, Microsoft, oh, yeah, it's got 18% vol. Yeah, 18%. Yeah, what the hell does that mean? I don't know, but it sounds good on paper. Okay? So here's a stock trading at $100. The vol is 20%. Okay? What that really means the stock can move, basically a standard deviation, $20. You're like, whoa. Back up there, cowboy. Standard deviation, what the heck is that? Basically, what it means is a volatility of 20% equates to approximately a 20% move up or a 20% move down, okay? And it'll stay in that range about 68% of the time. The only problem with volatility is that volatility, like this looks really, really good on paper. You're like, yeah, wait a second. If I know that this stock is going to stay between 80 and 120, and I could be right 68% of the time, then I can actually build trades around this idea. Well, you could. The only problem is this standard deviation, 68% of the time, is annualized, which does you not a good thing. Who cares? The stock can move basically what, $20 up or down over a year. You're like, hey there, a year? Come on, please. A year is just way too much time. I need shorter time frames. In theory, you could just kind of divide this number by 12, and it would give you how far the stock is capable of moving every single month. Okay? And it's a little bit more intensive, if you will, calculation of that. But it basically comes down to, this is how volatility works. Like, that's what it really means. Okay? And the 68%, that always freaks people out, one standard deviation. listen, everything you do in your life can kind of come into a standard deviation, right? There's really, really good drivers, and they're up here in the curve, right? There's only like maybe 5% that are really good drivers. Then there's 5% that are really, really bad drivers. But it's funny because you drive around your city and you think everybody's a crappy driver. Well, if everybody's a crappy driver, that means 68% are terrible drivers. Then the ones down here are so bad they don't even belong on the road. And the ones up here, okay, are just godly that don't even really exist. Anyway, you look at this and you think to yourself, okay, 68% of the time, you're like, okay, I get it. But what's so important about this idea is you can start to build trades once you understand probabilities. But probabilities don't necessarily discern that you're going to make money. When somebody says 90%, that doesn't necessarily mean that you're going to make money. But the reason I bring up volatility is this, okay? Why you really need to understand implied volatility. What does implied volatility delineate? Okay? Yeah, it justifies the option's current price. Again, in the end, implied volatility is supply and demand. So what you can really do is you can look at volatility, and we're going to do this in a moment, on one stock, and you can compare the volatility from one stock to another stock. Okay? Additionally, volatility, okay, what can you use it for in your day-to-day trading? You can extrapolate how far the stock is likely to move. And I say likely, it's probability. It's called an expected move. And that's exactly what we're going to be doing here momentarily. And then I'm going to show you a shortcut to be able to do this. And this is where, okay, this is where you really start to get like, a little bit like, woof, all right, what's he talking about? I'm actually looking at this. It's ultimately, okay, the same stock, and this is what they call just a distribution curve. You have a $100 stock. In 30 days, it can move what? From 94 to 105. 60 days, it can move from 90, basically 2 to 108. 90 days out, it can move all the way from what? 90 to 110. And all this is it's showing you, okay, if you know the volatility on options, you can extrapolate stock price movement. And this is actually termed expected move. Now, quickly, I'm going to go over to the trading application, and I'm going to show you exactly that. Okay? If you're not on Thinkorswim, it's okay. It's fine. I'm going to show you a shorthand methodology of being able to do this. We're going to go all the way. Well, let's go into another product. We don't need Microsoft. Microsoft is like, the stock with a nail in its foot. Let's get something with some volatility in it. Like, let's look at Tesla. Okay? So Tesla's about $195 stock. That's the last price. We're going to look 29 days out. I opened the 29-day options. If you look to the far right-hand side, they have 40% vol. Next to it, it says plus or minus almost $18. Why? Why is that even there? Like, why bother with the $18? Why? Okay? Because that's giving you the likely move in here. Now, there's so many ways that you can use this, and I'm going to get directly into that. But what I have to show you right now is this. I have to show you the shortcut. You may not be, okay, on Thinkorswim. It is the expected move. Okay? Here's the shorthand notation of expected move. Take the at the money put and just add it to the at the money call. It's very close to expected move. Okay? It's looking at what's termed the at the money put and the at the money call. And if you add these two together, it's called a straddle. And the straddle right now is trading for $16.53. That straddle, okay, is very similar to the expected move of $18. And this $18 expected move, that's just like a more mathematically refined methodology. Okay, but I cannot stress to you how important it is to understand expected move. And that's exactly what I'm about to jump into here momentarily, is like, you're like, all right, why do I have to know expected move? Let's start comparing volatility, one stock to another. I call everything a product. I don't care whether you trade Tesla or Microsoft or Walmart. I don't care. Trade oil. Everything to me is a product. Because in the end, what can you do? Buy it and sell it. Right? Doesn't really matter. And if you trade in the shorter duration, do you really think anybody cares that you're trading Walmart? It's a couple of symbols and an implied vol. The implied vol can be extrapolated to movement. That's all that matters. Okay? And I'm not trying to, say, well, what matters? Is the stock going up? Is the stock going down? For this conversation, it doesn't matter. What does matter, though, is when you look at Tesla, it has 41% vol. Then you look at Microsoft, it has a 20 vol. When you look at one versus the other, what can you decipher? Tesla, okay, even though it's a $195 stock, you're comparing a $195 stock to Microsoft, which is roughly a $40 stock. Notice I didn't even put the stock price down here because I don't care. What you can learn about Tesla is that the implied volatility, they're universal. Okay, universal meaning that you can then say, okay, Tesla is literally twice as wild as Microsoft is. Then you look at something like Herbalife. I put Herbalife up there. Why? Just for fun. What can you say about Herbalife? Right? It's a suicide mission, man. Okay, because it's what? It's like one of the most volatile products out there. 86% implied volatility. That's like your hair is on fire. You're like, holy crap, is it going to be out of business tomorrow or is it going to be 500? You don't know. Okay, and you start comparing like Walmart to Herbalife. Why do I bring up one product versus the other? Okay, for the simple reason of how you can use this. And again, the first, 30, 40 minutes of this presentation, I wanted to be just about implied vol. And like I always, say this, what has volatility done for me lately? I think I may have stole that line from Eddie Murphy, although I don't think he was talking about volatility. I start to realize as I put these PowerPoint presentations together, you shouldn't do this late at night after a couple of beers because I thought it was amusing, and then I realized reading it, later, maybe some people caught that. So how do different implied vols ultimately impact allocation of capital or how we view a stock? Told you, first and foremost, we have to discuss volatility. How you approach a more volatile market has got to differ from what you've been doing. It has to, okay? Because all too often, and again, I've been watching retail accounts for 15 years. And people like ask me once in a while, like, how many accounts? I would, on an average day, I would probably legitimately look at like just 10 different accounts because people used to email me every day working at the firm and, they email me, what do you think? What do you think? What do you think? By the way, nobody ever emailed me like with a good scenario. People used to email me and they go, I'm totally screwed. It's a day before expiration. Help me. Oh, please help me. And I'm like, oh, great. So I'd look in their account and I go, you're right. You are totally screwed. And the one thing that I would consistently see is that when we allocate capital, the people were allocating the same amount of capital to Herbalife as they were Walmart, which made no sense. Okay? It just doesn't make sense when you do that. And you're like, what do you mean? I always say like size matters. Okay? That was not supposed to be funny, I swear. And I probably pulled out a picture that was supposed to be in here and, we edited that one. Now, the size matters. Okay? Size matters because if you looked at the previous slide, you have a 17% implied vol and you have an 86% implied vol. You can't take $1,000. Let's just throw out a number. You can't take $1,000 and treat $1,000 in Walmart like $1,000 in Herbalife because Herbalife is how many more times volatile, right? And you start thinking about it, you're like, okay, it's like almost 5 times riskier. It's giving you almost 4 to 5 times the movement. So $1,000 is going to go a hell of a lot further in Herbalife. When you start to compare one versus the other, the easiest one is, let's look at Microsoft versus Tesla. If you had $1,000 vested in Microsoft, how much capital might you need in Tesla to get the same bang for your buck as Microsoft? Well, if you have $1,000 invested in Microsoft, whether it's stocks or options, I don't care. Okay, this is like a universal discussion. It's not even about iron condor. It's just leading us into the idea of volatility. Most people are getting it here. It's about $500. And that's exactly right. And you really want to start to think that way, all right, in different products because you need half the capital. And that's exactly the point. Twice the movement equals half the allocation size. Apparently somebody read ahead. Cut position size in heavy volatility because you're getting just way more action. Now before I go any further, forget about this whole thing about stops. Cut position size in heavy volatility, okay? One way you can gauge volatility is you can come over here, all right, into Thinkorswim or any trading application. Let's just gauge general volatility of the market. Lots of people look at what's called the VIX. The VIX, though, okay, it's become so passé. Like the volatility index. Like even CNBC now is talking about it. Once they started talking about it, I was like, I can't look at it. It's become mainstream. Nah, I poke fun at it now because the VIX, all it does is measures volatility in the SPX. But the VIX measures volatility 30 days out into the future. So it's like a risk metric 30 days out. Some people call it the fear index, and it's fine. Right now, we're in a 14 VIX. What are you going to do if we're roughly speaking in a 30 VIX? You're getting twice the bang for your buck, so you got to cut back your position sizing. Okay? And it's a lesson that a lot of people don't figure out until it's too late. And you might look at 14 VIX right now, you're like, oh, that's really come off. Okay? Yet, even though we're just off of all-time highs in the market, the volatility is still considerably greater than it was just a few months ago. A few months ago, we're seeing the volatility in the 11 and 12 level. Now it's the 14% level, and it came down, okay, in the last 2 days. And you got to like look at the VIX, and if you want to look at a chart, you can look at a chart. And I'm not a big market technician. Here's 3 years of volatility. You're starting to see more volatility. Okay, there's just again no if, and, or, but about it. And if you look at what's called historical volatility, this is a little study on the bottom of my chart. Historical volatility of the VIX. What is this saying? It's saying the actual movement of volatility is drastically larger than any time in the previous 3 years. Okay, that's what I'm basing, like, we're in more volatility right now. People are starting to feel the impact of this. So I go back over now to this PowerPoint, and it says if you use stops, you got to back them off the stock price and allocate less capital. What, again, does that mean? I don't, my own trading, use any stops at all. Okay, now, I don't think that's a fair statement to make without qualifying it. I don't use stops because I have the luxury of being able to sit in front of my computer. You know, one of the reasons I left, the brokerage business is legitimately I probably work an average week of 50, 60 hours, and it got so intense over the last few years. Like, it was becoming difficult to even trade and function, at work every day. And it just, it was a little bit of a more difficult lifestyle, a little more stressful. So, again, it's one of the reasons I go, I'll do a class once in a while. I love actually doing the chat rooms on a day-to-day basis. In fact, initially I was only going to do the chat room like once or twice a week, but then I just started doing it every day, and I'm like, I'm not stopping. I got to speak for at least like 45 minutes a day inside of the Simpler Options chat room. And I found a lot of people do use stops, but if you're going to use stops, all right, okay, it's a more rudimentary version of trading. I like the idea of you setting alerts and then trading out of a position, but if you do use stops, back them off in heavier vol, okay? Once again, I go back over to the trading application. We're going to bring up a stock. Let's bring up, for instance, Herbalife. Why? Because I know it's volatile. Herbalife is interesting. If you look at a particular stock, like Herbalife, I know you might be trading stock, and some people are just like so adamant. They're like, I want to trade stock, I want to trade stock, I want to trade stock. But even if you trade stock, you have got to look at what the options are telling you about risk for the future. If you don't, you're just doing yourself like a huge disservice, right? So with that, you look at this and you look 29 days out. You're going to hold this position for the next 29 days. You're like, okay, there's a normal $7.40 expected move. Now again, you may not have Thinkorswim. You may not have this expected move. Although I do know that even on TradeStation, I've seen some scripts floating around for expected move. Apologize, I don't actually have the expected move script, but I still believe in, like, using the cheating man's methodology. Just add the at the money put to the at the money call, right? Go over here to buy, down to what? Straddle, right? $6.26. Know that the market is likely to fluctuate at least $6 to $7. Knowing that, what do you have to do? You got to set your stops further away in volatile markets. Set the stop further away. Give the stock more breathing room. Because if you don't, the likelihood of you getting stopped out is all but assured. I'll show you precisely what I am talking about. Trader goes in and they want to hold a position. Let's say short duration. For instance, they want to hold a position just the next 2 weeks. I open up the 14-day options. Again, I'm not even going to trade. Okay? I'm not even going to trade the options. And I like what somebody said. Wider stops means more risk, doesn't it? Exactly. If you put the stop further away, it means what? You're giving yourself more risk, which means in turn, you have to what? Cut the position size. I love it. You have to cut your position size in volatility. Because, and somebody came in here and it was, all right, Pam Gamma. So Pam and I go back years. Glad you could join us tonight on here at Simpler Options. But what it comes down to is this. Like, let's say you set your stop at 36. Stock's trading at what? Almost 38. There is a calculation called probability of touching. There's about a 75% chance that we're going to touch 36 in the next 14 days. If you put a stop at 36, you got a 75% chance of getting stopped out. Welcome to a volatile market. It sucks. Look at this. The expected move is $5. You got to set your stop almost to the outside of the expected move. So you got to take 38 minus 5. Going to open up a few more strikes over here. Roughly 38 minus $5. Okay, let's go even more strikes. Sadly, I got to open up more. Go all the way down to the 33 strike. When you go down there, now you only have 43% chance of getting stopped out. Which means if you use a stop order, I'm telling you, you're going to get whipsawed left and right the more volatility there is. And it's a lesson, okay, that you will learn. One way or another, you will learn this lesson. And these, like, when people look at the probabilities, okay, where do these come from? The probabilities are derived directly from the option price. The calculations, these things have been around for decades, okay? I've talked to a lot of traders that even in the early 80s had calculations like probability of touching and probability of expiring, okay? And it's again, it's okay to have a 43% probability of being stopped out. And you say, why? At least it gives you the chance to be right. Okay, you're like, it's not much better than a coin toss. No, but if you're right directionally, let's say you were bullish, okay, and you needed the stock to go up, the stock can go up, but you have to give it more breathing room when, again, the expected move. Now, if you looked at a different stock, like the expected move on a $37 stock, $38 stock, is $5 over the next 14 days. Let's go to another stock of a similar value. Let's go to Microsoft. Microsoft, what? It's okay. Split hairs over here. It's $4 difference. But for 14 days left, it could move an entire $1.20. Okay? It can't get out of its own way. That's exactly the point that I wanted to make. So you can allocate maybe a little bit more, but you're going to get less bang for your buck. But then you look a little out of the money and like, here, the 41 stop. There's only a 40% probability of touching there. And again, you don't have to have Thinkorswim to do this. Okay? Just know that in heavier volatility situations, that you put yourself, okay, at risk. You got to back off the stop orders and allocate less capital. Think about allocating less capital. All right. I want to make sure that you guys understand the whole don't allocate the boat over there. You have to break through the learning curve. And to do that, to be realistic, you got to trade small. Okay. Respect the risk, cut your trading size. And I always say, you still love yourself in the morning. So you're really going to appreciate with the volatility that's forthcoming, knock it down some of your risk. So that's really where I wanted to start the conversation today. It's just predominantly about volatility and how the markets are going to become more volatile. We're right on time over here, about 40 minutes in. The next hour, we're going to focus almost exclusively on trade structure over there. Somebody came in here and said, I like the idea of selling Herbalife puts. You, sir, will like that idea until some horrific news comes out. Actually, I like the idea of selling puts. I would never, sell naked puts. It's fine to sell naked puts over there. I just always tell people, whenever you sell something naked, you got to have a little bit more of a stomach for that kind of a business. And to me, I have it because I trade a comfortable size to the point where, and I wasn't always like this, but I trade, when I say a comfortable size, I'll put an amount at risk in individual trades. To me, that's so minute, I just don't care. I really don't. I fire trades like water. I really do. I'll put a one lot here and a one lot there and a one lot there. I like to trade throughout the course of a day. Today, I was extremely busy throughout today, but I was still, what did I get, 7 fills today? And that was one of the slowest days that I've had. In a slow day, I'm still going to do 7 fills in a given day. I have to keep trading over there, and this is just some trades I have over, the simpler options, but, I got a crap load of stuff on. I always do. I usually run anywhere from about 900,000 to about 1.2 million in positions. I use portfolio margin. You can see that in portfolio margin, I'm still allocating almost $300,000. That's, again, some sizable trades. And I typically don't keep more than about 300,000 in my trading account at any time. I'm just about 300 grand right now inside of the trading account. You don't really have to, because with portfolio margin, it goes 6 times further. If you've never heard that term, portfolio margin, okay, put it out of your mind. It's for people that want to sell options naked, do higher risk stuff. It gives you a lot more margin. However, the downside of portfolio margin, okay, you can get yourself in deep. And you do have to have a larger account. You got to have at least 125,000, okay? It's not for IRAs. It's not for 401ks. It's a regular marginable account. You have to have at least 125,000. Legitimately, I wouldn't even consider it until I had 150. And don't think for a second that it's an advantage, okay? It's a matter of an experience thing. And if you were sitting right now and you're thinking to yourself, like somebody said, the broker must love me, okay? I hope they still love me. My heart will still always be with some of the guys that originally started, Think or Swim over there. I'm still really close friends with everybody there, talk to them almost day-to-day basis. But, I have to be a little bit more objective. I know some of you guys have IB accounts, you've got TradeStation accounts. I'm okay with it. And that's something that takes a little getting used to over there. So with that, by the way, yes, I do pay commissions, and my commissions might be a little cheaper than some of yours, but it's not because I know some guys at the firm. It's because I trade a lot. And if you trade a lot and you keep a larger balance, they're going to give you better commission schedules. Okay? So it's good stuff. Anyway, back over here. Okay? We're now ready for part 2, the Iron Condor. We're going to spend 10-15 minutes going through the structure of the Iron Condor. Then we're going to start to get into the criteria. Okay? So, like this, people are telling me commission schedules and stuff over here. By the way, somebody said, why is the volatility This is actually a great question, and I want to cover this. Because why is the volatility in TLT, okay, is about 15%? Then they looked at a product that was called TBT. TBT is exactly the double inverse. It's actually double inverse, which means, quite literally, double the risk, inverse the product of the TLT. Okay? Hence, again, it has what? Okay? Double the volatility. If you trade options in the TBT, or you actually trade the TBT itself, all right, you don't have to allocate as much capital per se because you're getting twice the movement. So something to think about over there. Okay, back to the iron condor. So this is where things are going to get more interesting, and this is what a lot of people really, came to get into this discussion. A defined risk position that's designed to profit from positive decay, what's called theta, and be profitable over a wide range of stock or index prices at expiration. Now, I gave you, quote unquote, the marquee definition for an iron condor. If you're like reading that right now, you're like, I have no idea what that means. That's fine. Let's actually get into logically what this trade is. Okay? What the trade really comes down to, and again, I'm only going to spend about 10 or 15 minutes really talking about the position structure of the iron condor. And this is more of like intermediary kind of class. Like I wouldn't say this is an advanced class. I wouldn't say this is a basic class. We're kind of intermediate. And in this kind of like intermediate class, some of you know what an iron condor is, some of you don't. It's okay. So we're going to talk about where we put these iron condors. We're going to talk about, a condor versus an iron condor. First of all, iron. The word iron actually means calls and puts. If it just said condor, that would be all calls or all puts. Iron condor denotes calls and puts. What is a condor? Okay? Like people are like, it's a very large bird. Exactly. This is what they term a wing spread. There's actually trades called butterflies. Butterflies, little wing spread. Iron condor, big wing spread. There's even an albatross. What's an albatross? A ridiculous mythical beast. Actually, no, they're real. And I've always wanted, like, for years, I'm like, can we put pterodactyl on the trading application? Because nobody can even spell pterodactyl, and I think that would be quite amusing. It's an iron condor. All right? Really what it comes down to, if I'll get into the logistics of it, this is a standard distribution curve. And in this standard distribution curve, okay, assume that this is where the stock currently is. We're going to sell out of the money calls. And we're going to sell out of the money puts. Okay, and you're like, okay. Okay? And by the way, we're going to talk about, winning trades, losing trades, getting ripped apart in these trades. It's going to be a good time. We're going to go through every odd and end, how you can make money, how you can lose money. I like talking about the dark side of the force, if you haven't noticed. Okay? Again, I came from the risk management really side of the business, which means what the risk management side of the business kind of means, everybody else's crap got thrown on my plate every single day. And they go, here's your crap, Don. Here's my crap, Don. Here's everybody's crap all day long. That's what a risk manager does. He sits there and he looks at a computer, and there's other traders trading. The risk manager massages the positions, which I do have to say this. Looking back, I thought that was like the lamest job ever. But looking back now, after all these years, it gave me more experience than any individual trader could have ever had, because I saw everything that other traders were doing. And then working in the brokerage industry was even better because nobody ever emailed me with good email. Again, they just emailed me with like, oh, this is going wrong, this is going wrong. And it was beautiful because I learned like every odd and end, like, hey, this sucks, that sucks. And I'm like, oh, okay, well, let's not do this, let's not do this. You get to see where people kind of blew up. In the iron condors, that's some of the examples I'm actually going to give you. So for a moment, let me go back over to a trading application. So whether you trade, again, here or not, Option chains are option chains, and I'm going to use a product right now called the spiders. Almost everybody is familiar with the spiders. Okay, the spiders, the S&P 500 ETF. It's one of the products that we're going to talk about. I'm going to go out in time. I'm going to get crazy. I'm going to go all the way 92 days out. You're like, ah, blasphemy. I'm just talking about the structure, though. Everything on the right-hand side of the screen, okay? I know my right from my left here. Everything on the right-hand side of the screen are your puts. Everything on the left-hand side are your calls, okay? Calls, puts. What we are intending to do, the underlying is trading right at about what? Let's just call it 110, okay? It's about, 210. It's trading right about 210. We're going to look at the out-of-the-money puts, and just to, for example, we'll sell 200, and we'll go equidistant. To go equidistant, I have to open up a few more strikes. We'll sell, for instance, the 220s. Now, bear with me for just a second. I'm selling the 200 puts, and I'm selling the 220 calls. Structurally speaking, all I'm doing is just selling out-of-the-money options. That is it. So when you sell the 200 puts and you sell the 220, okay, calls, what do you want to have happen? You're like, stay between the lines. Stay between the lines. Okay. When you do a trade like this, and I'm gonna try to display this over here to you a little bit. But when you do a trade like this, ultimately where you want to be, okay, is right in this zone. Okay. Anywhere between here, okay, is a good, happy place. If you break outside 200, you break outside 220, you're going to be in trouble. So we want to stay, again, in our very, very, happy place. This is the distribution curve in here. Did I draw enough on there? John Madden would be jealous right now. So, again, staying between the lines. But the problem is, if you just go out, okay, if you just go out and you simply put, all right, you go out and you have this idea, you're like, all right, I'm going to go out there and, great, I'm going to go and I'm just going to sell out of the money crap and just pray it stays between. Yeah, well, that sounds really good until the market crashes. And if the market does crash, you are in very serious trouble. And I'm telling you, you'll never be able to keep up with it because I have been there before. All right? And I'll tell a couple of stories about iron condors as I go along because I've been caught in some of the worst markets in the history of markets, and I have been naked short positions over here. So the idea of the iron condor is what we're going to do is we're going to sell out of the money crap, and we're going to buy other stuff to hedge it. Okay? And that really structurally is how it breaks down. So let's go back over to our PowerPoint. All right, and we'll look at the actual position. So here's a stock at 200. Okay, we're going to sell the 220, 225 call spread. We're going to do it for 50 cents. Now, yeah, I'm breaking this down, but the iron condor, it's all one piece. It's a four-legged beast. So yes, if you're a brokerage firm, do you love iron condors? Actually, no. There's a huge misnomer about the brokerage firm, and that is that they love people that trade four-legged spreads. The reality is they don't really make as much money as you might think of off four-legged trades. And this is where I always get myself in deep. I'm going to explain exactly why. They don't receive payment on the order flow. And if you know exactly what that means is they don't get payment on flow from iron condors, okay? Because the iron condors, they can't make anything off of. Like the market maker that takes the other side, they can't really make any money off of it. So in the end, yes, they make more in the commissions. The brokerage firm makes more in the commissions, but they don't make that much, okay, because they don't get payment on it. So Somebody said, why a $5 wide spread? I'm actually going to get into the specifics of just that. So bear with me. I'm just going through structural stuff here for the next four more minutes of structural stuff. And then we're going right into the candidates and exactly how far out of the money we're going to go. Thought about that one. But if you just look at this spread, here's a $5 wide spread. Okay? Here's a $5 wide spread. And it's being done for a 50-cent credit. So ultimately, when you have a $5 wide spread for a 50-cent credit, what can you lose in a $5 wide spread? Well, you can lose $5. Yeah, you can lose $5, but you've already received 50 cents of that up front. So your definitive out-of-pocket risk is $4.50. It actually gives us about a 90% probability in just this trade. We're not going to stop there. We're additionally equidistant going to sell a 180, 175 put spread. Let's also assume it's going for 50 cents. It's not going to work out perfectly that way. Okay? You're going to find out that markets are skewed up. Markets have skew, and skew will impact the out-of-the-money calls versus the out-of-the-money puts. And that trade also has about a 90% probability. But when you combine both of the trades, they only have about a 20% probability. And again, it goes right back to that distribution curve, if you will. So the probability of success in here is $1 credit. This part, bear with me, okay, for a minute or two. Critically important portion of this discussion. Okay? $1 credit. $1 credit, but now what's the complete risk in the spread? Well, you sold a $5 wide call spread, and you sold a $5 wide put spread. But how much can you actually lose? Okay? And when you start to look at this, at first you think, wait a second, you lose $5 here and you can lose $5 here, but you can receive $1 credit. So Don, you can lose $9. You cannot. If the trade is placed as a package, the stock can be at 200, the stock could be at 230, or the stock could be down at 170. But the stock can't be at 170 and at 230 simultaneously. Therefore, this is actually what we call risk-based margin. Depending on the brokerage firm that you use, they should only hold margin on one side of the iron condor. If they don't, okay, you're really kind of getting, that's not good because it's just tying up more of your capital. I hate when brokerage firms do that crap too. You really should have risk-based margin. And risk-based margin says like, all right, the reduction in buying power should only be the amount you can lose, which is ultimately risk is $4. Now, this is going to blow your mind, but this calculation, you're going to see it 5 or 6 times tonight. The probability of success. Take the risk in the trade. What's the risk? Take one side of this. It's a $5 wide spread. Take the credit on the entire iron condor, which is $1. Okay? So you received $1 credit on a $5 wide spread. The most you can then lose out of pocket, your risk, what I call real risk, is $4. Take the $4 divided by the width of one of the spreads, which is $5. 4 divided by 5 is 80%. Don't use analytical tools, okay, from the brokerage firms. Just use this methodology. And I will explain that why, okay? You know, over the years, I put a lot of effort forth to building some of the analytical tools, not only on Thinkorswim, but those tools, I mean, they're like the standard now in the brokerage industry. And I'm telling you, this little cheesy calculation, divide what I call the real risk to buy the width of one of these spreads, it's the best calculation you're going to use. Also, you want to know the break-even points. The break-even point. The short call, it's the call you sold, plus the credit. These 50 cents don't even exist. You received $1 credit. And we're going to go through examples here a number of different times. Okay, I know a lot of people are, when do you let the iron condor expire worthless? I'm going to get into all those finite details here momentarily. But I wanted you to see break-even point, short call plus the credit received, short put minus the credit received, short put minus the credit received, 179 your break-even points. Next, all right, there's actually the calculation, again, for break-even points and a capital requirement, your max loss. Now, I put the capital requirement in there. Different brokerage firms, some of them may actually hold margin on both sides. And if they do, it's unfortunate because they don't really need to, Moving right along over here. Now we're starting to talk about, entrance criteria. So with that, what do you guys think? Do you guys want to take a quick 4 or 5 minute break? Huh? Anybody? Anybody? Quick 4 or 5 minute break over here. And it's a split market. I promise it won't be any more than about 4 minutes. Okay. Be right back in here. I know it's about 8 p.m. Central Time. We'll kick it right back off at 8:05 Central Time. So I'm just going to put in here short break starting at 8:05 Central Time. All right. So we'll just take a quick 4 or 5 minute break. Be right back over here. Just enough time to run to the bathroom. Maybe grab a beer, maybe grab another coffee, whatever does it for you. Be right back on. All right, ladies and gentlemen, it's just about the break is just about over. Give you about 60 seconds more over there, and we will get rolling over here. I'm actually answering a couple of questions in here, so no, I absolutely do appreciate some of the questions. Somebody said, "What about Delta?" Okay, yeah, it's we're going to get into it here momentarily. That's actually, I thought the best place for a break would actually be in the candidate selection, and that's really where I'm going to start to get into Delta. In actuality, again, I know some people are coming back from the break over here. It really comes down to the fact that this is the stuff that I couldn't talk about, at a brokerage firm. You just can't talk about specifics. You can't say, I do this, I do that. It should be very general. And this is the part where, before coming aboard, a couple of conversations with John, I'm like, you mean I can talk about my trading? And he goes, not only can you talk about your trading, Don, you can trade in front of people. I'm like, that totally blows my mind, man. It's just, and it's by the way, this is no fault to any of the brokerage firms. It's the regulatory environment that we live in. And Dodd-Frank only made it that much more difficult working for a brokerage firm, and it really is like one of the primary reasons like I love to come out and to do these discussions and so forth. And it's one of the primary reasons I was like, that's it. I just, the regulations are such that you just couldn't take it anymore. I mean, literally speaking, you could not discuss an ETF, okay, without the actual transcript being read by the regulator before you could post information about an ETF in any type of an archive. And that's when you got to say, like, all right, they've gone too far. And the only place to live now is, is in an education firm like we're involved in right now. And, the other key point is, again, just being able to construct trades is only a small portion of the business. Okay. So let's jump into it over here. By the way, somebody said, is that because of like the license or just like, TD Ameritrade or Thinkorswim rules? The honest truth is it's not a TD Ameritrade issue at all. It's a regulator issue. And all the brokerage houses, the bigger the brokerage house, the more scrutiny there is, both internally and externally. And in the last, really since like 2008 and so forth, they've clamped down. The regulators have clamped down so hard on the brokerage firms that, I don't feel sorry for them. I just feel like, okay, so we can't do any education really. And the education that comes out of brokerage firms, like they sterilize it now to the point where like, all right, that's cool. It's a good logical thing, but you can't really do anything. And that's why like now, again, I couldn't wait to be, what I call like unleashed upon the markets. Let's get into this. So let's go in and start talking about candidate selection. You know, we looked at the idea a little bit here of building an iron condor, structurally speaking. Okay, but that doesn't build the iron condor, right? So again, what I'm about to display, some of it can get a little bit convoluted, and I'd like to throw that at you right up front. Some of this stuff get a little out there. It's why, like, number one, we're recording this presentation for you. Number two, we are going to provide you the PowerPoint, and the PowerPoint is going to have much of my criteria in it. It has all my criteria in it, okay? And that's really, you know, the goal of the class over here. So, again, it's all about a recipe to building different trades. You know, you follow a recipe, you can build trades, but you still then have to manage it. And managing it is also what I'm going to get into quite extensively here. So each one of these steps, okay, takes you through like what I call the gauntlet. It assists you in finding the precise variables for building your own trade. You kind of take my criteria, you kind of make it your own. You have to massage it a little bit to make it work for you. The markets and the volatility are always going to vary, okay? It's absolutely going to vary, but the trading criteria has to be consistent. So even if you take something that I'm doing here, okay, and that's fantastic, but you still have to actually come up with your own guidelines. Like, I can't tell you how much capital to risk. And that's the open-ended nature of, okay, this exercise. So we have to be able to get you to the point where you're able to construct the trades logically, getting in the trade, getting out of the trade, but you're still going to have to come up, okay, to capital allocation, which unequivocally I'm going to discuss in some extent, okay? And the second part of that is, you know, and it's just capital allocation, but really spreading the capital. And you're actually going to see we have an entire section tonight built into capital allocation because I think it's such an important area. So moving into this, okay, again, here's candidate selection. We're actually going to go into step one. This shouldn't surprise anybody. Index or equity products, index-related products. These are the ones you consider. SPX, Spiders, IWM, Russell, NDX, and the Qs. These are in preferential order, plain and simple. Okay, you don't have to panic to copy this stuff down. Okay, in my own account, I trade a tremendous amount of SPX. I do trade a tremendous amount of Spiders, the IWM, the Russell. Okay, the NDX, liquidity, it ain't great. We're going to talk about liquidity till I'm blue in the face here. The Qs, the Qs aren't doing it for me, okay, because the actual Q price doesn't really let me build the kind of iron condor I want to build. I totally am into, okay, index products. And if you see, okay, you can use equity products, stocks. Tonight's focus is going to be almost exclusively on index-related products. The stocks themselves really complicate risks. It's earnings announcements, okay? Earnings should be avoided. In the actual iron condor strategy that I am teaching, the earnings should be avoided. And I'm going to show you why. I'm not saying that you can't trade iron condors around earnings. Hell, I do it all the time. Okay? And I do trade earnings. I love earning strategies because like earning strategies, it's like there's juice around earnings, a lot of premium. But I'm actually presenting tonight a very risk-averse strategy. And yeah, I listed a couple of stocks below, but I'm really going to focus exclusively on index-related products. Okay, and the problem with the equity products, I'm actually going to give you the exact statistical problem here. If you get an index, okay, index trades in a particular range. If the index cracks outside of a given range, we can call the given range like a standard deviation channel. If the index cracks outside a given range, it is 6 times more likely to come back in to that standard deviation than is an equity product. And there has been just ample research on that. Basically what it's saying is this: when an equity makes a big move, it's because of an upgrade, a downgrade, a news announcement. Okay, the CEO gets canned and the stock rallies huge. They lay off 10,000 people and the stock rallies huge. Okay, it's not coming back inside standard deviation. And it really does complicate the issue, specifically in iron condors. That's why we're actually going to focus almost exclusively on these products. If you think it's limiting, it is. But I can tell you, okay, for many a year, I made a living of trading just the index products. I grew up trading nothing but index products initially over here. However, okay, I really want to focus on a couple of things. Some of the entrance criteria. You have to check for high open interest in front month contracts. So whatever the product that you trade, okay, I really, okay, want to enunciate what I'm looking at. This is not indicative of every single strategy, but what I'm about to teach you guys is a softer, gentler way to trade iron condors. And when I say a softer, gentler way, okay, you're going to be very surprised what I'm going to show you here in a moment. That's why this is going to matter. And I think that, by the way, all three of these lines over here are ultimately repeating themselves. You know, open the near-term monthly options contract expiration to examine the open interest. Okay? The option strikes have open interest in the hundreds and some strikes in the thousands. What does that mean? Okay, go over to the trading application. Oh, can I find the trading application? We're going to go over to our trading application. And again, use front month. That means either 1 day left, okay, and after there's 1 day left, don't even use the weeklies. Use the monthlies initially. I want you to look at the open interest in the monthly contract. It's critically important. If you take a look, okay, I'm going to flip open to what's called volume and open interest. Clearly, there's extensive volume here in the spiders. But is that true of a product like the NDX? The NDX, there's 0 days left in the NDX. You must find some strikes at least in the thousands. If you don't, you got to move on. Okay? And we're going to talk about more than just that. Okay? But again, you have to understand that I'm trying to put you guys in the best possible marketplace. So check options volume in front month contract. Open near-term monthly options expiration contract to examine the volume. And again, I want to reiterate a couple of these points over here. All right. Essentially what I'm saying, liquidity and tight spreads. Okay. But I spent like 5 slides saying liquidity and tight spreads. And a lot of people are going to be like, what about this product? What about that product? I don't know. Let's look at a few products. Okay. So we can look at more than, for instance, one product. Somebody mentioned a moment ago, don't write this down. The SPX PM. This is an SPX PM settlement product. Okay. First of all, close up the product. It doesn't even have weekly options. It's a dead giveaway. There's not going to be liquidity. Open up the April. Open up the March. Some of the strikes are starting to get into the thousands. The volume might be there. The very fact, though, that it doesn't have weekly options on it becomes limiting. Now, you're looking at the 29-day options, okay, and there's almost no liquidity at all in there. The bid-offer spreads, okay, this thing is almost the same product as the SPX, but the bid-offer spreads, you know, we're $1 plus wide in here. And when I say it matters, like I can't express this enough. You're doing a 4-legged trade. These bid-offer spreads are really going to start to add up. There are no weekly options on here, which is very limiting as to what you can trade. So we'll look at another product again, like NDX. Look at the NDX. It's got, you know, some liquidity. The bid-offer spreads, they're formidable. But then you realize it's a $4,000 product. Holy crap, that's a big product. You know, look at something really quickly with me for a moment. Look at the bid-offer spreads. Now, clearly, this is aftermarket. They're like $4 and $5 wide. You're like, oh, you could drive a truck through the bid-offer spread. But the reality is, it's a $4,000 product. Then you look at a stock, and you trade this all the time. You look at something like Priceline. Okay, I'm not picking on Priceline. But you go to Priceline. It's only, what, an $1,100, $1,200 stock. Its bid-offer spreads are like almost $2 wide. So, whose spreads are wide? The NDX or Priceline? Well, Priceline's a little bit wide. Comparison, right? Priceline is 1/4 the size of the NDX. But its bid-offer spreads, okay, they're not comparable because the NDX has bigger bid-offer spreads. But that's how you reasonably, okay, have to look at one product versus the other, right? By the way, somebody said, are you looking at volume or open interest? Well, let's go back over to the criteria here briefly, okay? Because the reality is, I'm looking at both. If you looked at one slide, check open interest. Open interest in the near-term monthly options contract. The open interest, okay, has to be in the hundreds, and some strikes have got to be in the thousands. The next slide, number 3 over here, is check the volume. Option volume is critical in receiving good pricing when entering and exiting. Why? When you're in a marketplace, you want other market participants. If they ain't loud but it participating, okay, it's more difficult to get in and to get out. Now, it's not always 100% essential to have unbelievable volume. There are types of trades that you can do where you don't have to have ridiculous volume. However, the trades that we are doing, you do have to have these types of iron condors. Okay, it is a very stringent criteria. You better have volume. Don't even consider, okay, if it doesn't have volume. And the easiest thing to do, if you're thinking I'm spending a lot of time on this, you're right, because people lose money because sometimes they trade products that simply don't have the volume over there. SPX, Spiders, IWM, Russell. If you stuck with those 4 products, happy days. Because you're going to learn something again in a moment here about how I'm going to build the irons. You could use the SPX, the Spiders. These mirror one another. That's problematic. So use the SPX, maybe the Russell. Okay, but they kind of also have a relationship. All of the products have a relationship. Okay, logically, you could just trade one product, and you'll pick one. I will tell you this in my own trading. I always find products that I'm in favor with and not in favor with. Right now, me and the Spiders and the SPX are getting along. Okay, there's a love affair there. And I say, don't ever have a love for a product. No, it's okay. The SPX and the Spider are love and dawn right now. The Russell, okay, I have divorced the Russell 3 times over. I moved this thing out of the house, and it still comes back to haunt me. I don't know what it is with me and the rut, but they don't get along. I have always found in my own trading, I'm hot with certain products over time, and then I completely suck in other products at different times. And I hope you guys don't mind me saying that, but, go into your account and actually look in your trading account, okay? Look at your trading account sometime, whatever it is, and go into the account statement and, look product by product. Look the equities, look at the option positions, look at your profit and losses, find out what you're good at and what you're not good at. Because you're going to find out, seriously, that you're unbelievable in one product and terrible in another. And start doing more of what's working and less of what's not working. So I move forward over here. I think I killed that one. Bid-ask spreads. Check the bid-ask spreads in several expiration cycles. Here's the thing, okay, and this is something I'm going to make you very, very aware of. Bid-offer spreads right now might look decent. Okay, so here you are today or tomorrow when you're entering this trade and the bid-offer spread looks decent. A month from now, when the, hits the fan out there, when the volatility hits the fan, bid-offer spreads are going to widen out. So you better get in at a good price because sometimes you need to get out, okay? And when you need to get out, the SPX, the NDX, and the Russell, I put this eloquently. Markets and products like the SPX, the NDX, and the Russell can be, challenging and require a more experienced trader. The SPX, the NDX, and the Russell, for years I called the SPX the Widowmaker. I called it the Widowmaker because the bid-offer spreads in the SPX can get wild and extreme. All right, if you want to see the most volatile market, I'm actually going to show you the most volatile market that I ever really traded in. Okay, and I love to use this example for bid-offer spreads because I want you to be aware. Getting into a liquid product is everything with iron condors. Because when the market gets crazy, and I'm telling you, it will get crazy. All right? You want to see a rough bid-offer spread? We're going back, okay, to one of my favorite trading days in the history of markets, okay? And I'm actually going to go to one specific day, October 10th of 2008. October 10th of 2008. Here's the SPX. It's trading at 900 on the button. It was only down $10 that day. Look at the range in the day. It went all the way down to 840 and all the way up to basically 940. It had a 100-point swing. That's almost a 12% swing in one day. Look at the bid offer spreads with 6 days to go. Okay. Yeah, baby. All right. $8 wide. Make a market. No, I don't want to make a market. The market makers are so freaked out on a day like this, they literally say, I'll make a market. Okay. And then basically you're subjected to whatever they want to do. Here's a market, $60 by 73. What do you want to do? I want to cry. All right. That's some of the reality over here. So it's just again, part of learning the bid offer spread. So if you're newer to this, consider penny increment markets such as spiders, IWMs, when you're really first getting involved in a trading vehicle. Enough said over there. Overall liquidity, I like to throw this out. If you have to question liquidity, then it's not liquid enough. When it comes to liquidity, go big or go home. Non-liquidity products are a non-starter. Enough said over there. Okay, let's move on. If you use the spiders rather than the SPX, you might have to use more contracts because the SPX is 10 times the size of the spiders. But I'll get into that. Okay, I'm actually going to get into that. Expiration selection. Iron condors can be sold for short and long durations. We can sell irons anywhere from days to months prior to expiration. This is the part that's going to be the shocker. All right. Okay. Short duration irons, less than 3 weeks till expiration, they're going to incur more directional risks. It's actually called what they term negative gamma risk. It's your directional risk. It'll kill you in short duration premium sellers within a volatile market. Okay. One thing that is often not told to traders is that in the weekly options, I love weekly options. I trade lots of weekly options, but in weekly options, you have very little defense mechanism, especially in heavier volatility. The heavier the volatility, the less you can actually do in such a short duration of time. We all know that options decay faster the closer you come to expiration. We all know that. Ooh. But what a lot of people don't realize is that although the options are decaying at a more substantial rate, that rate is inversely proportional to the directional risk that you're incurring, which basically means this. We could be burning at a faster rate. I'm actually mousing like a little decay graph over here. Okay, we're burning at a faster rate. I'm actually going to show you exactly what I'm talking about here momentarily. I'm going to draw this on my screen. So if this is a decay graph, okay, options, the closer they come to expiration, are burning at a heavier rate. Like here's an option trading for right around, what, $1. And then the option eventually goes right to zero. But what a lot of people don't realize, this is a 1 month option. So that's, $1 for 1, okay, month. It's kind of fun over here. $1 for 1 month. This is actually 0 time left. But what's going to occur is the amount of directional risk you're going to incur to get this decay is inversely proportional. And the irony is that if this is your directional risk, the directional risk actually has an acceleration curve even slightly greater than the decay graph. Now that's something that nobody tells you. Okay? You can trade really short duration, but you're going to incur more directional risks. And the heavier the volatility gets, the worse the directional risk can be. Again, this particular strategy night is very, very risk averse. Okay, and it's designed specifically to avoid, all right, that heavy amount of decay risk. So where do we go from here? Okay, we're going to look to sell what's called a duration iron condor. It's a sell and bail. We're actually going to go, and we're going to go all the way out to where? 50 to 90 days out prior to expiration. It's going to reduce our directional risk. We're actually going to sell iron condors all the way 50 to 90 days out in time. And you're like, that's crazy. Just wait. Oh, just wait. Because there's a lot more going on here, okay, than you might see up front. The expiration selection, really 50 to 9 days is a large window. However, we're going to be placing multiple iron condors. And we're going to require a 40-day window to spread out our capital into multiple expirations. Okay? Truth be told, put all your capital into one iron condor. Let me show you exactly how this is going to look. You put all your capital into one iron condor. Okay, and I'm going to show you exactly what I'm going to do over here. So let's again kind of sketch this out for you, if you guys don't mind. Here is your iron condor. Okay, your iron condor can profit in this particular window. Put all your eggs in this iron condor basket. All your risk is right here and right here. It doesn't matter whether you do it 10 days out, 50 days out, 90 days out. You put all your eggs in one iron condor basket, you're going to get run over. Okay? What you really want to start to do. By the way, somebody said, I thought you said you were using front month options. We looked at front month options to assess the what? The liquidity. Why? I need to know which shorter duration options, bid offer spreads, and open interest are going to be, because I need to be able to get out with smaller amounts of time. Getting in, okay? Getting in is one faction. Getting out, though, is critically important. It's why I was looking at short duration. So what we're doing is we're actually going to consider, instead of one iron condor, we're going to layer iron condors. We're going to layer them over multiple expirations. Okay? It's actually a little bit of a military tactic. Put all your troops, okay, in one or two locations. You can get taken out in one lump sum. Spread your troops amongst multiple expirations. What does it do? Smooths out the line. Okay? And that's exactly what we're trying to do in this particular circumstance. So, I'll come back to that here momentarily. I'm having fun with the drawing tools tonight. Okay, so moving right along with this idea is, again, multiple iron condors. All right, we're going to discuss closing out irons. But I'm already letting you know right now, we're going to sell and we're going to bail. We're actually going to discuss closing out irons 30 days prior to expiration within the closing criteria. Remember, we're talking about bailing out before suffering heavy directional risks. It's a sell and bail tactic. It's to avoid the steep amount of decay. And this is going to be very surprising to you, but we're going to build an iron condor momentarily, and I think you guys are going to be shocked. The best amount of decay is not always in the shortest window possible. When you're selling out of the money options, even 90 days out, suffer a massive amount of decay. Okay? When all the way 60, 70 days prior to expiration, they decay very, very heavily. Okay? So we're going to talk about everything on iron condors, from the fills to the slippage. Absolutely going to discuss that. Okay, strike selection. Ballpark. This is the most difficult portion of what we're going to be teaching tonight. And over the next half an hour, we're going to talk about the rest of the entrance criteria. Then we're going to talk about the exit criteria. We're going to be answering some questions. We're going to look at capital allocation. We have a lot to cover. About 30 minutes. So, and I'll stay here, okay, extra half an hour, 45 minutes to get through some of the questions. The strike selection. Ballpark. The call option you're selling should be around a 6 to 10 delta. Okay. This is one thing I'm going to focus on. Once you know where the call option you're selling is, okay, it lays the entire iron condor in place. And I'm going to show you that. In products like the SPX, you want to sell $10 or $20 wide spreads. Down here, I've actually got a screenshot. In my own trading, I use $10 wide spreads, and I use the SPX. Okay, I will trade the spiders, but at the size that I trade, I typically have to trade the SPX. I will tell you, I think that the spiders are a much more effective tool for learning this strategy. The most experienced trader that's listening to me right now, okay, you may be experienced in placing irons. You may not have experience, though, in how I'm going to allocate my capital, and that's really where we're going to focus. And sometimes jumping back over to the spiders can be helpful. Otherwise, use one lot in the SPX. I do. I'll trade a one lot, okay, a one contract trade. In ETFs, look to place $2 to $5 wide spreads. Again, I'm very, very specific. Now, I'll go back to this momentarily. Remember, a 6 to 10 delta call option. That's going to be critical. Make your iron condor strikes equidistant if you want to be completely neutral in market direction. So your call spread's approximately the same distance from the underlying price as the put spreads. Okay. If you go back to the slide, it says use a 6 to 10 delta. What? You're ballparking a 6 to 10 delta call option. Let's go over to the platform. Let's see if we can't build this thing. Now I'm going to go into the SPX, close up all the different expirations. Okay, let's actually go to the trade tab. Close up all the different expirations. Number one piece of criteria, you had to select your product. I did. I selected the SPX. Don't be scared of the bid offer spreads. Why? Okay, so number one was product selection. Number two, okay, we went deep into liquidity. Number three was more about liquidity and volume. Then we actually started talking about what? Expiration times. 50 to 90 days out. Now, if you're at the 91-day mark, don't panic and go, oh, I can't go past 90 days. Okay, don't split hairs. You can see I've got a position in this one at 85 days out. But in this particular case, let's do an iron. Here, I already have one built. Right now, June 2. Let's use the weeklies. The coolest thing about the SPX, it's got multiple weeklies, weeklies and weeklies and weeklies and weeklies. That's a long week. We're going to build an iron condor 70 days out. And you're like, you're crazy. Maybe. But I'm going to show you exactly why we're going to do this right now. First, you got to open up a whole lot of strikes because we're looking for an option that has a what? Okay, I was really specific in that criteria. Back to the slides here momentarily. Okay, look for a call option, not a put option. You got to look for a call option that's between a 6 and 10 delta. Okay, why am I so adamant about that? Go over here where it says open interest, and I'm actually going to pull up delta. Every trading application, if it doesn't have delta on it, okay, then you need another brokerage firm. I am going to throw that out there. Seriously, if you don't have that on there, it's time to move on. What are we looking for right now? Well, my criteria basically said I'm going out 50 to 90 days. And it's a really big window, and I'm going to show you exactly why it's such a big window. The next thing, I got to go between a 6 and 10 delta. Here's a 6 delta, here's a 10 delta. Okay? In this particular case, I'll tell you what, I'll ballpark it. I'll go right to the 6 delta. I'm just ballparking it. You look at the bid offer spreads, it's 205 at 250. Okay. Now what else did we say? Use a 6 to 10 delta. So I got the 6 delta. The 6 delta. That's the option you're selling. Okay? So that's the option. If I'm on Thinkorswim, I would right click, come up to sell, and I go over to what's called Iron Condor. Now, it immediately says I'm selling the 2230, 2240. Remember, once again, in my criteria, what did I want? I wanted a $10 wide spread. This is a $10 wide spread. I just built a $10 wide spread. Then I said, well, sell your call spreads approximately the same distance from the underlying as put spreads. That's net what we call a neutral trade. So what you have to do is you have to sit here. Okay, if you want to open up a calculator, you can totally do that. Okay, when I say open up a calculator, let me just show what I'm talking about here. We're selling a 2230 call. A 2230 call. The underlying price is 20, basically 90. Say, let's say minus what? 2090 equals we're $140 out of the money. Okay, so we're $140 out of the money. Well, what do I do then? Good. Then go back to 2090, subtract $140. What does it come out to? $19.50. Okay, what should I be doing then? I should probably move my put strikes all the way out to about the what? Okay, right about the 1950s. I'm selling the 1950s, and I'm just going to buy, what did I want? $10 wide spreads. Selling the 1950s, buying the 1940s. Boom, $1.95 credit. Okay, let's assume in this particular equation, maybe you're not even going to get $1.95. But I will tell you this firsthand. I routed a bunch of these trades recently. They're trading within 5 cents of the mid. Okay, and we're going to talk extensively about selling these spreads. Okay, we're going to let them work, and I'm going to talk exactly about how to get filled efficiently on here. Somebody said, between a 6 and a 10 delta, is the 8 delta preferred? I'm going to show exactly that. Okay, I'm going to show the preferential treatment in here. I knew what questions were coming. We want a probability of success in the iron, quite specifically between 80 to 90%. If you go into a much higher probability iron, you can do that. But when you start getting trades that are 95% probability irons, when things go bad, they go bad in a hurry. And you can really subject yourself to, undue risk when you start going to higher probability trades beyond 90%. We have a ballpark delta. We still are going to use a probability calculation to check our iron. Calculating your iron's probability of success. How do we do it? I went through this. I told you I was going to go through this multiple times. We take the real risk in the iron divided by the total width of the spread. The calculation are as follows. Okay, here we go. First, I'm going to take you through this mock calculation. Then I'm going to take you through the literal one right on the trading application. Okay? By the way, do not look at the put delta. Only use the call delta. Do not look at the put delta. So a few of you are actually questioning that right now. You looked at the call delta, and the call delta took you right in the neighborhood of a 6 or an 8. This is a cheating man's methodology of finding a good iron condor. If you look at the put delta of the option that we're selling, the 1950s, that put delta is all the way at 20. Don't look at it. Okay? Not consequential right now. Just make the iron condor equidistant. If you know the call delta, it lays the rest of the iron condor together. Okay? Anyway, with that, it's just, that's kind of an important portion of it. All right. By the way, somebody said it didn't have any volume per se on that. It didn't have any volume today, but if you did actually look at, like, you guys, you look at volume, open interest, the most critical thing is that in the shorter duration that it does have volume and open interest. So the volume out here is not going to be nearly as essential. And it's because the weeklies inside of the SPX, specifically the weekly contracts, they are now actually traded in an electronic marketplace. Even though the open interest is relatively nothing, look at some of the other strikes, and the open interest is absolutely huge. Okay, the open interest, again, it will come. And it's a reality of the markets. You're trading way out of the money stuff. Okay, the executions, though, in here lately have been phenomenal, and they've only gotten better in recent times. You guys know me for years. I would never talk about the SPX. Now I'm talking about the SPX because the fills have been so good. So let's go through. This is a similar iron that I constructed the other day. I actually think I had this trade on. Basically what we're doing is we're taking the total risk. The total risk. If it's a $10 wide call spread and a $10 wide put spread, then the total risk is $10, of which we received a credit of $1.80. So if you have basically a $10 wide spread, a $1.80 credit, that comes out to what? $8.20 of real risk. It's actually what I call the total that you can lose. Again, the real risk is the width of the spread minus the credit received. For the probability, take the real risk divided by the width of the spread. That's it. Now, I know that this seems complicated the first couple of times you go through it. Okay? When you start to look at this trade, and I'll talk about profitability projections, all of that here momentarily. Okay? By the way, somebody said, on my experience with the SPX lately, also that I can normally get filled near the midpoint. I'm telling you guys, in the SPX, I'm going to say this eloquently, I have routed a ton of trades in there, and I actually routed multiple trades in there just in the last couple of days because, putting this presentation together, I always hesitate talking about the SPX. I just have for years, and I'm like, the hell with it. We're using the SPX because the fills are damn good in there. And save you on some commissions. 820 divided by $10, 82% probability. Okay, that's how you figure out probability. Now, I'm going to move on. Okay, let's go back over to the trading application. What's the probability in this iron condor? Let's say that we got filled at about $1.90. It's $10 wide call spread, a $10 wide put spread that you received $1.90 up front. Therefore, the definitive out-of-pocket risk, okay, definitive out-of-pocket risk is 810. How do you figure out probability? Okay, we'll go over to our trusted calculator. Take $8.10 divided by $10. Probability of the iron condor is approximately 81%. Okay, this is one of the easiest ways to figure out probability. Now, okay, you can do higher probability irons, but the higher the probability, the less the credit you're going to receive. If the credit, for instance, were only $1, okay, $1, you got $9 of risk, but then you have a 90%. Everything in this business is a trade-off. Everything's a trade-off. The ideal spot that you want to be, okay, for these kind of iron condors, you want to be in the 50 to 90, okay, day window, and you want to be between about an 80, okay, again, an 80 to 90% probability. Now, I'm going to talk about executing your iron condor here momentarily, because I think that it's such an important portion, okay, of like selecting contract size and so forth. Before I do that, back over to the trading application, I want to show you why we're doing iron condor so far out in time, okay? Bear with me for a moment. One of the key points that I'll make this evening, okay? By the way, I'm projecting right now that officially we should be done by probably about the neighborhood of about 9:15 Central Time, and then I'm going to answer some questions thereafter. I'm projecting about a half an hour left of the presentation here. I hope you guys don't mind that. I know some of you are on the East Coast joining me kind of late over here. Hey, you got to get up early in the morning. So do I. I'm going to be in the chat room back tomorrow. We are definitely recorded over here. One of the things I want to focus on, and this is, okay, simply one of the most important things. I'm selling, again, I term these things duration irons. I'm selling 78 days out, but this is the reason why. We're going to be looking to close these things, okay? Let me just show you exactly we're going to be looking to close them. For instance, when there's still like 36 days left, and you're like, man, why aren't you just driving this sucker home? Come on, take me home, take me right into expirationville. No, we got to bail. We have to bail because all the directional risk comes in those last 30 days of an expiration cycle. So the one thing I want to show you is, look, take a June 1 iron. Watch what I'm doing. What's a June 1 iron? How many days are left? There's 78 days left. What's a June 1 iron going to look like? Let's say 30 days from now. So right now we have 78 days. What's this iron going to look like 30 days from now? I know. Take the 78-day iron and push the date to the May 2s. Look where I am, okay? And before I actually do it, I want you guys to see exactly what I'm doing. So I'm actually gonna draw on the screen for a second. I hope you don't mind, because this is such an important portion of the conversation that everybody kind of misses. Okay, we are actually going to take, and we're actually considering executing the trade 78 days out from now, but we're going to estimate what 78 days is worth by looking at what this iron would be worth during the 50-day expiration. To do that, all you do is take the date right here and just change it. Just change it to the May 2s, because it's going to tell you what this iron condor would be worth, assuming the market didn't move. Assuming the market didn't move. It would show you, though, how much decay the market would have over that period of time. Okay? And this actually kind of freaks people out the first time they see this little like gizmo of doing this. So I'm going to take this thing. I'm just going to shove the date forward. I'm going to shove it forward to what? The May 2s. So let's go right here, okay, to the May 2s. It's worth $1.10. So all of a sudden you just sold it from $1.90, maybe down to $1.10. But wait, that's only with, okay, what? 30 days of decay. We're going to take a 78-day iron. We're going to drive it home, and we're going to be exiting these things with about 30 or 40 days left. So we're going to be driving it close to like where that April 4 is. So now take it and drive it to the April 4s. There's only 80 cents left. You're receiving over 50% of the decay. Over 50% of the decay will occur, okay, before you get into the last month of the chain. That's the whole key to this, okay? There's an easy amount of decay because you're not incurring that much directional risk. Do you realize to collect that last little oomph, you got to take all the directional risk? And the directional risk gets exponentially larger the closer you come to expiration. So we're going to sell it and we're going to bail the hell out before that actually occurs. Okay? I'm assuming not a big market move. What if the market does move? We're going to go through that. We're going to move the market up. We're going to move the market down. We're going to move it left. We're going to move it right. We are going to estimate different market moves over there. So let's go back to those June ones. Okay? Because I want you to see, again, that good amount of decay. That example was specifically for the decay. Before I go any further, though, let's talk about executing your iron condor. Select the contract size for your iron, whereby you're 100% comfortable taking 100% loss. I'm not telling you that you are going to take 100% loss, but I am going to tell you it can happen. It can happen, and any time that you get into one of these iron condors, whether you want to hear this or not, okay? I have been in a marketplace. It crest through my iron condor so quickly, there was no way I could have ever executed out of the trade. Okay? Things happen, it gets crazy. We're going to be allocating a very small amount of capital to each individual iron condor. A couple of little quotes I use in here. There's no superheroes in trading. If you believe there are, there just are not. You know, you hear guys like Carl Icahn. Is he a superhero or does he just move markets by tweeting? Trade small and live to trade another day. FHW, option trader I have known forever and ever. Okay, here's another fun quote. I think this actually comes from the same guy. There are old traders and there are bold traders, but there are no old traders. Hence, that's of course an old trader. By the way, FHW is the old trader. A buddy of mine, he's actually been trading since 1974, a year after options were legally listed on the Chicago Board Options Exchange. So I just threw that out there. When you're comfortable with the risk and the trade you've created, look to execute the trade. All right? Again, one contract trades are fine. Initially, price the iron condor at the middle or mid. Okay? Confirm your order is accurate prior to sending. Remember, we're selling the iron condor to open. Read the order back to yourself prior to sending. Real quick, back over to the trading application. Before sending this thing off, make sure, number one, that you're selling the iron. When you hit confirm and send, this is a confirmation screen. They got these pretty much in every single trading application. Selling the iron condor to open. I'm telling you, I have been trading for years. I have 300 grand in this account. I fire one contract trades. You're going to understand why. I started this presentation telling you, make sure that you're on a per contract fee with your brokerage firm. You're going to do way better with a per contract fee. Okay, my max loss in here, $805. Okay, I don't think you're going to be able to execute it for $1.95, but I am going to tell you, work it at $1.95. What's the worst that's going to happen? You're not going to fill. Okay, read the order back to yourself. Initially, let your orders work at or near the mid price. Work your orders, work your orders, work your orders. Markets fluctuate. There's no reason to force a trade. I know that some of you work during the day. If you want, okay, you can, push the button a little bit off the mid price. After 30 to 45 minutes, cancel and replace your order at a few pennies from the mid price. Okay? Your irons are 50 to 90 days out. This is the point that I want to make. There's no reason to force a trade at a bad price. You have to realize the bid-offer spread, the slippage. You give up 5 cents, I'm not going to cry. You give up 10 cents, I'm starting to get angry. You give up 15 cents, come on. What are you going to give up 15 cents for? There's no reason to do that. See, the iron condor, okay, doesn't take much directional risk. And the cool thing about the iron is, I put one on inside of an account over here. let's just look at this account. I put an iron condor on just to make a point the other day. Here's an iron that I put on. Now this iron condor, the P&L from the open, it's up $2.50. It's one contract, which basically means when did I put the iron on? I don't know. Let's click on it. It's a live trade over here. I put it on, okay, on Tuesday. Today is Thursday. Was it Tuesday? It was Tuesday the 17th? Yes. I put it on Tuesday. Today is Thursday. Great. Okay, there's my iron condor. The funny thing is, it hasn't budged. I'm just showing you the trade hasn't budged. It's 85 days to expiration. It hasn't budged in price. Did the market move? Hell yeah, it moved. Yesterday you saw a 30-point up move in the S&P futures, down 10 today. The market's moving. The iron's like, oh, I'll get around to moving one day. That's why I like them. They're so far out of the money, they're like, maybe we'll move, maybe we won't. That's what we're looking for. We want decay. Okay? And decay takes what? It takes time. Just think about it for a second. It takes time for decay to occur. So don't force the trade. You got all the time in the world. Now, to continue on this theme here, okay? Let's actually go back to the PowerPoint. Executing. After receive a fill, breathe deeply. You know what your risks are, and now you're ready to manage the trade. All right. Here we go. Exit criteria. It's not that easy yet, okay? I'm getting you into a trade. Now I got to talk about getting out of a trade. But after I talk about getting out of a trade, this is not it. Capital allocation, capital allocation, capital allocation. We're not just getting you into a trade. We're going to get you out of the trade. But we're also going to teach you guys how to allocate capital. I have to tell you, over the years, okay, I thrive in volatile markets because I'm really good at allocating capital. I get into trades that I'm comfortable with, okay? I'm not fearless. Believe me, I'm not fearless. I have screwed myself a number of times in markets, okay? Every time I've been in trouble, every single time, you can lead it back to one thing. What is it? Overallocation. Okay? Nobody ever gets in trouble and goes like, oh, I'm so screwed if you have $800 allocated. Okay? Granted, some of you, you know, it's all, you have a $2,000 account, you could have a $5,000 account, you could have a $2 million account. The smaller the account, I'm telling you, stick with the spiders. Then you can have risk in a trade of like $160, $180. Okay? Trade small, stay small. I'm telling you. Okay? You want to survive volatility and you want to bring in some decent income over here, you stay small. And what we're actually going to teach is the allocation becomes at the forefront of the strategy. We're going to ideally look to exit the iron 30 to 40 days remaining to expiration. Remember, we're bailing out prior to taking heavy directional risk. But not everything trading is going to go good. So here's the real examples and the alternatives. Basically what I'm telling you, not everything's going to go your way. All hell's going to break loose. Okay? One thing I want to talk about, 30 to 40 days remaining to expiration. We're going to talk about a closing window. Okay? The most significant factor in successfully trading the iron condor is you got to get out when closing a position. The window, a closing window, keeps you consistent and alleviates short-sighted emotional decisions, closing out 30 to 40 days prior to expiration. Okay? But what if your iron condor gets threatened? And again, this is something that I have to stress. Okay? If you have a bunch of iron condors and the market crashes, great question. We're going to talk about that. Markets can crash. We're always going to keep some what we call powder dry. All right? And we're going to talk about when to stagger into these irons. Let's first talk about a single iron condor. We now have one trade on. What if the iron condor becomes threatened? Quite simply. Not going to get too cute. Exit the iron condor if the short call strike exceeds a 35 delta. That's it. 35 delta. If you breach a 35 delta, jump, run, bail. Okay? If the delta of the short call goes from, for instance, I think we used in our example like a 6 or an 8 delta. If it goes from like an 8 delta to a 35 delta, exit the iron condor immediately. A lot of trading platforms, you can actually set an alert on delta. Don't leg out of the iron. Just close the entire iron. Because if the call spread is being threatened, the put spread is going to be far out of the money trading for next to nothing. Let me show you what this looks like. I have a legitimate iron, okay, right here in the SPX. It's all the way out of the money. I have the 20, okay, 22.20 strike, okay, 22.20 strike. And when you start to look at this trade, it's a 9 delta right now. When a 9 delta, okay, this is the option I sold. Focus on the option I sold. When the 9 delta crests above a 35 delta, jump, run. Why? I'm going to show you. Just buying back that particular spread, okay, it's going to be $4.30. You're going to take a loss, okay, but it's a long way off, and that's assuming that no time passed. Every day that passes is going to help you. In the Iron Condor, let's say that there's 50 days left. There's 50 days left. You're getting so close to your window. And the market rips to the upside. Okay? The market rips to the upside. And all of a sudden, your option that you sold goes to a 35 delta. We're just going to use this option. Doesn't matter. It's a 35 delta option. Okay? The option you sold goes to a 35 delta. That's the 21.25. Do you realize you got to get pretty damn close to where the stock is when there's only 50 days left? I mean, that's the 21.25. That's only what? $35 out of the money at that point. And at that point, again, some time has passed. Because the time has passed, again, we're closing out of a $10 wide spread in this case. It's still trading for $4.20. I'm showing you right now. We sold an option. We sold the Iron Condor originally for what? About $1.90. You sold the thing for $1.90. If you hit a 35 delta, you're probably going to lose $4.20 just on the call spread. You're going to lose probably another 20 cents on the put spread. I'm actually estimating your loss in the event that you do lose on an Iron Condor. Okay? And you might not like the risk reward, but the probability is on your side. By the way, tonight, we're not so much going to talk about rolling the trade, because rolling the trade brings in an element of ultimately, okay, what? If you roll the trade, you might be prolonging your agony. It's not bad to roll trades. It's a little bit outside the scope of what I wanted to cover today, but I will tell you this about rolling a trade. If you are going to roll a trade, hands down, unequivocally, you roll it for a credit or you simply don't roll it. Don't even ask twice. You gotta roll them for a credit, because if you don't, it's just going to dig you in a deeper hole. Now somebody's asking, when do you bail out on the downside? I haven't forgotten about the downside. Okay? Is that 35 delta intraday touch or close? Okay, so a 35 delta. Basically, what I'm going to teach you guys this really quick. When you go out to the original Iron Condor, the original Iron Condor that we built, we are all the way out of the money. What strike we're using? 2230s. If you want to see the 2230s, the probability of touching 2230, if you're interested in that, the probability of touching it, it's only about 11% probability. The probability, though, of a 2230 strike becoming a 35 delta, okay, it's actually in the neighborhood. Now, this is a very complex equation. You can't just look at probability of touching. So you want to know what's the probability of touching the short strike on the calls, okay? It's in the neighborhood of about, okay, 25%. You have about a 25% chance, okay, that you could touch the short strike of a call or a put. But that's a 25% okay, probability through the life of the entire 78-day expiration. We are actually bailing out, okay, 30 to 40 days before expiration, which actually takes the probability of touching all the way back down, because we're bailing out of the Iron Condor, takes the probability of touching to less than 15%. You have less than a 15% chance of closing the trade, okay, early. Just keep that in mind. But it happens. It absolutely happens. And when it happens, it can happen very, very quickly. Now, back over to the PowerPoint presentation here. All right, don't let it out of the trade. If you open it as a package, close it as a package. Don't just close the call spread. Because what I don't want to see happen, you close the call spread, then the market comes crashing down and hits your put spread, and then you lose not once, you lose twice. Just bail the whole thing. Now, this is the put strike. The put strike can go all the way to a 45 delta. By the way, put deltas are negative deltas. When the put delta exceeds negative 45, jump, bail, dive. Get the heck out. Again, you can set delta alerts. Let me show you what that looks like. So one of the some of the most important pieces of criteria, exit on the call side. If you're short call, it's a 35 delta. Exit on the put side if the short put exceeds negative 45 delta. Back over here to the trading application. If you take a look at the trade that I have on right now, okay, I am short the 1880s. If those 1880s, which are currently a negative 14 delta, if the 1880s become a negative 45 delta, which is on almost a stock, I mean, you're almost on the SPX at that point, becomes negative 45 delta, bail. By the way, the loss over here should be the same as the put spread. Should lose about $4 if this happens. In this case, only 335. Why do you lose less with the put spread? Because even if volatility explodes, the puts have skew. And actually, when the market's crashing, as long as you catch the market before it catches you, bail out of those puts, okay, before they become a 50 delta, the skew is actually going to help you. It's actually quite ironic that in the iron condor, everybody always perceives the risk to be to the downside. You're right. The risk is to the downside. If the market crashes, I mean totally crashes, you're going to get hammered. Okay? And you're going to get hammered, and we're going to teach you to distribute your capital. But one of the biggest risks in the iron condor is actually to the upside. The upside is what people don't look for. And unfortunately, when exiting the iron condor, the upside risk can really hurt you. And I always point that out to people because they don't see that risk coming. And I'm going to tell you, it's hit me a number of times in my career. I got ripped on an iron condor in October. October 15th was the bottom. This last year. By the way, if you have no idea what I'm talking about, let's go to a shorter duration chart right here. All right. So I put on a couple of iron condors on the way down because as the market's tanking, the volatility was pretty good, and I'll talk about that. The market ripped to the upside, and I got hit, okay, I had a lot of iron condors on. I actually got hit on 3 of about 7 irons. And I was shocked because I don't think in a period of time I can remember in recent history that I got hit on that many. I got ripped to the upside. It happens out there, okay? And I still had a couple on, and I was pretty nervous, and we sold off a little bit again. I allocated more capital in this sell-off, then we ripped to the upside, but I was okay. And the next time we ripped to the upside, these 2 days, okay, I actually was in Chicago those 2 days. In fact, I was in Chicago with John and crew, and we were visiting, some of the different offices and so forth out in Chicago and some buddies of ours, and the market was just up basically 100 points in 2 days, and it was like, wow, that was some upside move. I didn't get tagged in there because I allocated right in this neighborhood. So my iron condor was clean, at least at that point. But this move to the upside in the SPX, it got me. That'll happen. Okay, and I'm going to show you that. I don't mind talking about losses. In fact, I think sometimes talking about the losses help you guys more than talking about the wins over there. So, by the way, so I lost. Yes, I lost more to the upside than the put side. Yeah, the upside. Okay, there's actually ways to manage risks to the upside over there, but that takes a little bit beyond there. So, exit the iron via buying it back. Extreme bouts of volatility can make closing trades a lot more challenging. Okay, when you're buying back in extreme volatility, use the mid price in an ETF. Use a mid price, add 5 cents. That's for spiders, IWM, and Qs. In bouts of extreme volatility, though, in something like the SPX, use the mid price, add 15 cents. Iron condors themselves, they're not, okay, they're not wildly volatile trades, meaning the trade itself doesn't just lose money, snap overnight. Okay, it's usually a grind to the upside that gets you. And you have to be proactive in closing the trades. On the upside, when you hit 35 delta. On the downside, when you go to negative 45 delta, you bail out of the trade. Okay? Now, again, this is one of the most important concepts that I ever get into here. Okay? Again, somebody said, what about rolling out a leg? You can roll legs out. And it's a little bit beyond what I want to cover tonight. Because tonight, I think it's, in the time that we're given here, I think it's more important to talk about the capital allocation methodology than I do think about rolling. Rolling, all it does is pushes trades from one expiration to the next or multiple expirations out. Rolling can be effective, but I've also rolled myself into an oblivion. Rolling means moving position from one expiration simply to the next expiration, okay, or further out. Once again, if you roll for what? A credit. You got to roll for a credit. You have to roll for a credit. Okay? Capital allocation. But I talk about the curse of dimensionality. Oh, fun topic. Okay? Every word of what I intend to get to is covered in this PowerPoint slide. Allocation technique can be the single largest factor in your overall effectiveness through volatile markets. You got to really think about this. Breaking up your capital into multiple expirations and spread the risk to many strikes. You don't want all your troops, your capital, in one location when the vol bomb goes off, and it will go off. Okay? You always are keeping capital, okay, on the side. You never allocate. Like, let's say, for instance, that you want to trade 10 grand. You don't allocate the full 10 grand. You just don't. Okay, you're always taking capital off, okay, in one trade, putting it into another trade. You always got to keep some allocations dry. Another thing, if you plan to allocate $10,000 into an iron Condor inventory, why would you do just one big iron? Consider 10 individual irons, each being one contract. One lot, 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 spread 10 individual irons all over the place into a minimum of 3 expiration cycles. Allocate slowly. You take one iron Condor off, you may not be able to get another one on. I'm going to explain that. Okay? I know that this sounds like a complicated tactic. I also know that the idea of 10 different trades, you're like, that is going to be a huge pain in my ass. It's not. It's actually really, really easy once you've done this. I'm not saying you have to go out and initially allocate 10 different trades. You're just not going to do it, okay? At a minimum, you got to have 3 different expiration cycles rolling at the same time. It's diversification by a capital allocation. The curse of dimensionality. I actually stole that phrase, okay? That phrase actually came out of a firm that in 1998, about 2 months after I started trading, a firm went up in flames. It's called Long-Term Capital Management in 98. It was the summer of 98. Very few people really knew that this was going on, but this one firm almost took down, okay, the entire marketplace. One firm. They were leveraged like 1 to 200 and 1 to 300, and banks were actually forced to bail out long-term capital. And there's a phrase that came out of there, and it was called the curse of dimensionality. Basically what it came down to, long-term capital sold volatility, specifically in the SPX, because they thought volatility was high. And they screwed up. All their models said volatility was high, and it really, really was high. But what they did is they screwed up, and they took the allocation and they threw it all into, okay, shorter duration premium selling. And these guys just whacked the hell out of premium. And of course, what happened? Volatility went up even higher. And they termed it the curse of dimensionality because basically their entire strategy was allocated into one expiration. Because they were allocated into one expiration, they couldn't get out because the volatility got jacked. See what happens in volatile markets? Volatility and really heavy volatility may move here in the short duration. Volatility 80 or 90 days out isn't going to move as much. Okay? There's actually a term for this. Some people may have heard this. It's called contango, which is termed backwardation. If you don't know what that means, you're probably better off for it. Just basically means options way out into the future are not going to be impacted as much. So this firm goes out and they sold just a crap load of options like in a 30-day expiration. Volatility explodes, they're toast. They've called it the cursed dimensionality. And I've always remembered that logical piece over there. And one thing you always did at a trading firm, we sprayed capital everywhere. We actually called it spraying. Avoid layering risk on similar strikes, even when using multiple expiration cycles. Critical point. You're short an SPX 2220, 2230 call spread as part of an iron condor. Don't allocate another trade at or near the strikes in any expiration. When allocating capital, avoid selling irons at similar strikes. Parallel irons suffer losses simultaneously. It is one of the biggest mantras that I have. Basically, if you look at my iron condor, I got risk on the upside right here, 2022. I can even open up my position down below. Okay? And because my risk is right at that 2220 strike, if I allocate an iron condor, even with 64 days to go, what do I have to avoid? I might not be able to allocate right now because look, if I'm allocating and here's a 7 delta iron, I'm at the 2210 strike. The market's actually going to dictate how you can allocate. Stick and move, stick and move. Allocate, let the market move. Allocate, let the market move, up or down. How far do you have to move? Okay. Generally speaking, if you're in the SPX, you better make sure 20 to 30 points off a previous strike. Basically means this. If you're at the 2220 strike, you need to either be allocating to the 2240 or even the 2250s. Okay? Or you're allocating to the downside, you're at what? Okay? You're at basically the 2200 strike or maybe even what? The 1990 strike. Again, I stress this so much, okay? This is actually to circumnavigate. Somebody said, hey, this, trading in a volatile market. The most effective market to be able to allocate these iron condors in is going to be heavier volatility. It'll work now. It'll work now, but the allocation technique is expressly designed for more volatility. The more the volatility actually picks up, what does it let you do? It lets you allocate more frequently. Markets that aren't volatile, that are not volatile, you're grossly underallocated. Markets that become volatile, now you're firing. So the strategy itself becomes more effective in heavier bouts of volatility. That's why I'm saying, hey, the market's going to get more volatile. We know that. Okay? You have to get ahead of it. You have to have been allocating these irons. And right now, even when you look 78 days out, it's a 16 vol. Even in bouts of heavy volatility, you're not going to see these back month options change that much. You want to see the most extreme case of volatility. Go back to the Analyze tab. Okay, and in this Analyze tab, what I'm going to show you, this is the most extreme volatility. Well, I shouldn't say that. It's the second most extreme day in recent history of volatility. Look at the options that are 97 days out. They're jacked to 51%. But they didn't explode like you may have thought. That's one of the biggest bouts of volatility in the history. It's the second biggest bout. Okay, what was the biggest bout of volatility? I believe the peak of volatility was on November 20th, 2008. It is. Okay, that's actually the day the VIX hit in the 80 handle. And irons that were 91 days out jumped to 70 vol. Okay, in a normal bout of volatility, what's more normal? Okay, well, let me show you. I actually like using this think back. It's just end of day crap, but I like using it because what's a normal bout of vol? Okay, back in October, yeah, we hit a patch. We hit a little patch of volatility, so let's look at it. Okay, so let's go to October 15th. October 15th, the vol picked up. Okay, let's go to our iron condors, though. They're 72 days out. Take a look. Vol was only at 23%. That's the point I wanted to make. We're already trading in a semi-hefty vol. See, I'm trying to get you guys into irons in this. What's coming is volatility. I'm trying to get you guys into irons, though, that you're not going to get your head taken off when you're 14 days out from expiration, because you will not be able to control volatility. You see, the shorter duration irons, look how high the volatility got in short duration. You're all the way here to 30, even 36% volatility. Okay, you can't control that kind of risk. You can control, we got crazy, we got to 23. When you were exiting the iron, even 30 days before, highest you got was 26. And this was actually some of the heaviest volatility we've seen lately. Okay, so keep that in mind. Trading further out in time, I'm protecting you from directional risk, but I'm also trying to protect you from bigger bouts of vol. Okay, and somebody said, does the low IV percentile influence me? Okay, so conceptually, there's an implied volatility percentile here. In the IV percentile, there's high IV and low IV, but you never know where you are until you have a percentile. And we're answering a couple of questions along the way. Hope you guys don't mind. We should be generally wrapped up here in about 10 minutes, and I'll be able to answer some more questions. But IV percentile, it ranks from low to high. Now, this particular tool on this trading application, okay, myself, Tom, a few others were really influential. Like we basically said, you guys got to build this. The IV percentile only really ranks 30-day volatility. Okay, so it actually looks what's the highest volatility we've had in 52 weeks, what's the lowest volatility we've had in 52 weeks, and where we currently are. It just ranks it. It says right now the vol is like 14%. We're at the 24th percentile. Okay. You don't have to worry as much about the IV percentile. I know some of you right now are being like, I'm getting thrown under the bus, man. I'm just trying to figure out allocations. I'm trying to figure this out. Now you're talking IV percentiles. The way that I've structured this presentation, you don't have to worry nearly as much about IV percentile. Why? You can still effectively trade irons in a lower vol. But what you're going to find, you're not going to be able to allocate a lot of capital in lower vol. Why? If we don't move, you can't allocate. Don't stack risk on top of risk. Go back over to this presentation, and it ultimately says parallel irons are going to suffer losses simultaneously. If you cover the same strikes in 3 different expirations, when we go down, you're going to get whacked in 3 different expirations simultaneously. When the implied volatility gets higher, what we call our higher IV percentile, you'll actually be more allocated, which is basically what is it doing? It's pushing the accelerator down in heavier volatility, taking off the accelerator in bouts of lower vol. And that's what this cursive dimensionality is about. I'm telling you, allocation should be at the forefront, okay, of what we think about. Okay, again, allocation needs to be at the forefront. So what hurts an iron? IV increasing or IV falling? Iron, ironically, the iron condor itself, it is volatility sensitive. I'll go to the Analyze tab here and the risk profile. So here's an iron condor. This is a live one. I have this one on. Okay, and I'm not going to go down Geeksville. I'm going to delete this slice. I'm not going to go down Geeksville because I'm a geek. Okay. Everything from like when I first got involved in this business, the stenciling model, the binomial, the black shoals. Okay. Yes, I can recite the equations. You know what? That doesn't do me any good. It's never going to make you a dime to even know what a stenciling model is. Nobody cares anymore. It doesn't matter. Okay. I will tell you this. Look, the volatility exposure is negative. If volatility goes up, theoretically, I lose money. But in the end, worry less about the Vega risk. There's actually very little volatility risk in this trade. I'm only losing $35 for a 1-point move in vol. Look at, I'm only losing $35 for a 1-point move in vol. And you saw some decent volatility The vol went from 16 to roughly like 23 or 24. Okay, so let's say vol moved by 6 points. Okay, 6 points times $35. It's not going to kill me. People worry so much about like Vega. You know what I'm worried about with iron? This is what I'm worried about for you guys. Okay, so bear with me for a moment because I'm going to draw this on the screen because I think that this is the kind of example that enough people just don't talk about. The most important things in these types of trades. Okay, let me just pick the right color in this and make sure that you guys are seeing exactly. One iron condor can be very dangerous. Remember, what you want to do is you want to allocate, okay, multiple iron condors. So there's another iron condor. Then the market, for instance, rallies. Before you know it, you've got another iron condor. And all you're trying to do is smooth out this risk curve. Because if you put all your risk right here, believe me, you're going to get tagged. Spray risk on multiple strikes and multiple expirations. Think about this, though, when you're trading. Okay? Those that put all the risk in one spot will lose their capital at one time. Okay? I keep stressing this because it's like the underdog. It's not talked about enough. And trading firms, this is all they talk about. How can I spread my capital? How can I spread my risk? What does my risk look like? Okay? It's unto itself, I'm forcing you into a set of rules. Okay? And that's like, I'm roundabout, basically. I'm forcing you into a set of rules by saying parallel irons will suffer losses. And I'm also forcing you into this idea, whether you know it or not, I'm forcing you to this idea. Heavier volatility allows you to allocate more capital. That's what we're talking about tonight, trading in more volatility, right? Well, guess what? You're going to trade more the more volatility is. It's because it's actually going to hit the accelerator, and you're going to go for it. Last but not least, a quick recap. And I know that a lot of you right now, you're like, no, don't make it end. I got questions. Cursive dimensionality, spread your risk, achieve diversification via capital allocation, multiple expirations, multiple strikes, spread your capital to a minimum of 3 expiration cycles. Don't place large trades because it's more convenient. Okay? I think I need to enunciate that one more time. Do not place large trades because it's convenient. You want a large trade? Oh, your risk is at 2 points. And the volatility bomb goes off. What's a volatility bomb? One day you wake up and the S&Ps are down 40 at the open and you're like, oh, hell yeah, you're going to get killed. Okay? I have been there. Watch. I'm going to take the market, okay, and I'm going to go through an exercise. I'm going to move the S&Ps down $40 at the open. Okay? I moved down 40. Irony is this particular iron does well because it was getting hit to the upside. Watch. Let's move this market down a crazy number. Let's move it down 100. I'm estimating the market moves down 100. Okay? That takes me here. See where the line is? Taking the market down here, down a whopping $26. I put you in positions in an iron condor. The market can creep up on you, but it's unlikely that one big volatility bomb is going to hit you. I intentionally built the iron condor at an 80 to 90% probability, okay, because it's unlikely, and it can happen. It's unlikely, though, that we have a big killer move. Now, the hidden risk, if the market goes down 100 points, the volatility can explode. And when volatility explodes, let's move volatility up. In this iron condor, it's not going to move more, okay, than about 10 full vol points. If you move 10 full vol points, now you're going to suffer about a $200 loss. And this is a live trade in a live simulation, okay? It's realistic. I'm taking the volatility from where it currently is at, 16%. I'm moving the volatility to 26%. And yes, I'm using the Thinkorswim Analyze tab to help me along. And I don't think it's like essential that you understand every single tool in this Analyze tab. Okay, I'm a total like geek in here, but it's not necessary to go through here. Just going through, like, again, if you're a little lost right now, I'm serious, go back through this. There's so much that we've covered tonight. It's okay. In 2.5 hours, go back. Literally review some of this. because I think it's going to help you a lot because you're going to pick up different things about the capital allocation. Last but not least, what I call getting tweaked. One strategy variation. This only takes 2 seconds to cover. One strategy variation. Those that are extremely experienced. Okay? Those that are extremely experienced. What you can actually do is you can go out and you can look at your call spread, okay? The one that you're going to sell. Now again, I am throwing this in there as an odd or an end. Then I'm going to answer some questions. You go in here and you're looking at this spread. It's a 22.20, 22.30 for 90-cent credit. I'm just looking at the call spread. Instead of selling the call spread, if you have the margin capability, you come up and you can actually sell the call itself naked. Here's a market of 55 by $1. You might get filled at like 80, 90 cents. You take the effective call spread that you were going to sell, and instead of selling the call spread, okay, instead of selling the $10 wide call spread, you find a call further out of the money that's trading for the same value. Okay? Again, this is not for the faint of heart. This is a tweaked iron. I do it because I have portfolio margin. What I'll basically do from time to time, okay, I'll actually sell, for instance, the naked call. Now I'm slightly further out of the money with the naked call. Then I never would sell the put spread naked. I'll just go out here and still use the same put spread. And it's actually what I call, it's my bastardized iron condor. I'm collecting a little bit of an extra credit on it. Okay? You can't really figure out probability. At that point, it's just a variation, okay? This is about more of my imagination in a trade than it is anything. The more experienced you become, the more effective you can become. See, my biggest risk as a trader is that I wake up one morning and the market's down 100. That's my biggest fear. If I wake up one morning and the market's up 50, look, we're at 2090. If we go up 50, that's not going to hurt me. I sold what? The 2250s. When the market moves up, volatility goes down. Therefore, the call that I sold naked doesn't explode in value. When the market goes down, volatility will kill you. You always hedge your puts in, okay? You always hedge puts in index products. Selling puts naked in index products, the SPX, the spiders, the Qs, the NASDAQ. Selling puts naked can be a recipe for disaster unless you are simply put one of the most experienced traders out there. Okay? You can do great for a period of time, and then the wheels can come off the bus. You want to make sure that doesn't necessarily happen to any of you in there. Okay? So again, I stress so hard, don't sell the puts naked. You can get away with selling the call naked. But that's kind of what I call, like, my strategy variation over there. And it's not like, imminent, oh, I need to do this. I just want to show you that. And it's something like you got questions about it. You'll see me do stuff like this. For those of you that are in the chat room on a day-to-day basis, you'll see it. For those of you, if you attend some classes we do in the future, you'll see it. Okay? And, again, I don't want to hide any of the strategies. Okay? Does the variation have a name? Not really. I call it Don's Bastardized Iron Condor. I hope you don't mind that one. I just came up with that about 5 minutes now. I've been calling it that. I just call it that. So there is no perfect delta theta ratio for an iron condor portfolio, but I'm going to grab some of the questions momentarily. Again, kind of recapping a few of the things that we discussed today is that, we learned to obviously try to thrive in the volatility of the markets. And that is pushing the accelerator, the more volatile markets get. Helping you guys just understand what volatility is. The first 40 minutes of tonight's presentation, that's what we did. Talked about specific entry and exit criteria, taught you how to build a little bit more of an inventory. And again, I stress so much, capital allocation, okay? Allocation is king in my mind. Always has been, always will be. And it's one of the things that, working for a big brokerage firm, they don't let you say, hey, you need to distribute your capital effectively. You need to distribute to this delta. You have to let markets move. Don't place capital on top of capital. Finally, you got to embrace the horror. The best I've ever done in markets that are wildly volatile. Because you can sell crap so far out of the money, it's unbelievable. You sell an iron Condors 200 and 300 points out of the money. Don't be afraid of selling stuff 90 days out, okay? Sell and bail, sell and bail. Get out of the crap before you actually hit, volatility and that directional risk kind of head on. A few other things. I actually requested to do this class, okay? And I requested to do it during market hours. There's something that I have wanted to teach, okay, for the last, 10 plus years. And I'm packing this class. By the way, this is not a big pitch. I'm doing this class like I have wanted to talk about this for 10 years, and I'm going to talk about it next Tuesday. It is during market hours. It has to be during market hours. I'm actually going to be talking about a guide to order execution, and it's the ultimate guide to order execution. Basically, what I'm going to do is I'm going to show you guys how your orders are executed. I'm going to talk about high-frequency trading, okay, how it impacts you. I don't care. I'm going to talk about exactly how the order routing process works at any major brokerage firm. I'm going to talk about what's called internalization of order flow. That is, who does the brokerage firm farm your order out to? And how can you actually jump ahead of that order flow? The entire class is really about order execution. How can you get filled at a better price? Every product is slightly different, okay? Yeah, the Gold Room, we place and manage live trades, but I'm telling you guys, like seriously, I'm doing the class a little bit more for me than for you guys. It's like nobody's ever really talked about this, and we'll put a link out there. If you want to go to it, great. I don't expect it to be nearly as substantial. Again, it's during market hours. It has to be during market hours. I will try during that period to route no less than 50 trades, okay? It's my own account. It's my own capital. It's my own commissions. I don't care. I'm going to show you exactly how the algos treat your trades. There's no market maker behind the trade doing evil things. But I'm going to show you how the algorithms are actually programmed, that you can actually bait algos your way and then pop trades behind them. And we're going to have a good time. We're going to fire some trades. You're going to learn stock routes completely differently than options. You're going to learn that futures trades, that's the Wild West, baby. That's the first in, first out marketplace out there. So it is going to be like the ultimate guide to order execution. I'm telling you right now, no one has ever done a course like this that's been in the brokerage firm for 15 years. Okay? And I know that, lots of people have talked about it. I'm going to talk about, again, exactly how the orders are actually routed and so forth. And lots of people have traded live. But I'm going to trade live for the express consent of showing you how to get better fills, and how to actually put your option order, very specifically the option order, in front of other trades over there. The whole entire goal of this class, I just want to teach you to save money in transaction costs, because everybody has to spend commissions, right? So you got to spend commissions. You can spend commissions. Hopefully, I teach you to save a couple of bucks in every trade that you do to overcome the cost of your commissions. That's the entire goal of the class. And you're going to understand more about high frequency and crap than you've ever wanted to do, and the algorithms and so forth with that. By the way, if you want the link to it, I think our guys can probably post a link into the chat room over here, but I'll pop the link up there, and I'm actually going to answer some questions as I do that. But let's see if I can actually find the link over here. In any regard, I've got it. So I'm actually gonna pop the link in front of you guys so you can see it if you do want it. And again, I make no two ways about this. I put this class together because it's just something I've wanted to do. The class itself, it's not going to have a ton of it's actually not going to have a ton of PowerPoints in that particular class. It's going to be much more about live trading. So again, I hope you guys don't mind, me giving you the 2-second pitch on there. In any regard, let's answer a couple of questions over here and kind of wrap things up over there. If an ETF, okay, is in a turbo squeeze, behave the way an individual equity would react. Okay, so this is something that I got to get to. As you may or may not know, I actually come from a quantitative trading background. Okay. The trading background that I had, I was involved in arbitrage and stuff. I'm actually not a huge market technician. The irony of that is, in the last 2 months, pretty much since, I've known I'm coming aboard, obviously, at Simpler Trading and Simpler Options, and I've been working with John, I've actually looked at technicals. I totally understand all the technical issues you guys talk about. John is probably the first person that I've worked with that actually has swayed me very slightly. I'm just not a big technical trader. It's not that I don't look at charts. Okay, I don't look at a lot of setups and so forth. With iron condors, I got to tell you, with irons, okay, I just play whack-a-mole. I fire really small contract size. I really don't care. Like if the market's in like the most wild uptrend ever, I'm like, yeah, I'll sell an iron. If the market's tanking, I love it even more because the market's tanking, then volatility is expanding, and I'm getting a better premiums further out of the money. So, I'm not really looking too much at the technical setup. There is one thing I'll look at. I will once in a while, I will glance at that IV percentile. The IV percentile, I've used it for many, many years. So I do look at that, and I have tendency to push allocation when implied volatility is higher. Okay. Somebody says, so is all you trade iron condors? I don't. I trade all kinds of crap. I absolutely trade, multiple strategies. One of my things is I trade in 3 different time frames. 3 different time frames, not just 3 different time frames in terms of iron condors. I trade intraday. Today, you want to see what I did today here? Okay. Today, let's see if I can find my account. I whacked a couple of trades today. What trades did I whack today? Okay. Traded a couple of futures, an iron condor. I closed that crap out. I did some Walmart. So some of the trades I did today was intraday stuff. Okay. The future stuff was intraday. And I closed some spider stuff that I had on that was also intraday. So I do trade on an intraday level. Okay. Additionally over there, I also trade on what? Okay. I trade like iron condors, which are like medium duration, a month, 2 months, 3 months out. I'll even trade some weekly options, some strategies there. I'll trade around earnings announcements and stuff. I would consider the iron condor a staple in my own trading. It's at the core of what I try to do, sell premium and manage risk behind it. Then last but not least, I have what I call, long duration trades. I trade stock, People talk about like investments. I don't have investments like other people do. I'll buy a stock and I'll sell options around it, But I take a slightly different twist. I'll actually go out. I like to be short stocks and sell puts against them. It's like the inverse of a covered call. I have stocks that I love to hate, so it's a good question, all right? Do you use futures options for condors? Yeah, so I will once in a while trade options on futures. If you trade options on the futures, I only trade the E-mini options on futures. That's it. The other options on futures are not wonderful. Okay. The VXX. If you're using the VXX is one of the most horrific products ever created. The problem with the VXX is there's a roll because the VXX is actually created from volatility futures, and every time the volatility futures roll, the VXX degrades. If you really want to see this, and I did this in the chat room actually earlier today, go to a chart, just look at the VXX. Don't look at it like over like 1 year because that's not even fun. Look at it over like 3 years. Just look at the VXX over 3 years. You'll never trade the product ever again. That's a chart. That's a real chart. That's 3 years. Look at it 5 years. It's ridiculous. The product itself is degrading. It's on a one-way ticket to zero. And you can't get short the product because they're usually hard to borrow. But yeah, the VXX it's a flawed product. And people go, that's not fair. Do you know what's funny about the VXX? It's an ETF. Now you know why brokerage firms don't let their associates talk about ETFs, because spiders, which are an ETF, fall into the same category as the VXX, and they get a bad name over there. So, yeah, I mean that's one of the reasons, working for a brokerage firm. UVYX also, you can trade UVYX like options, but the markets are a little bit wide over there. Somebody said, can you please explain back in the Iron Condor, the short put strike selection? all I did in the short put strike selection of that iron Condor was I went out and I selected a spread. I'll go back over and show you on Thinkorswim here. I went out, okay, into the SPX or the spiders, whatever product you're comfortable with. And once I went into the SPX, okay, I scrolled all the way out, and what did I look for? Somewhere right in this neighborhood, you know, the 9 delta. I actually used an example, though, that was in the 71-day expiration, right? And I went right into this like 7, 8, or even 6 delta. You take the 6 delta, okay? Then how do you find the put strike? Or I used the 7 delta, which is the 2220s. All you do is take the underlying price, okay, up to the 2220s. And it's approximately what? You know, 130, 140 points out of the money. If this is 130 or 140 points out of the money, then just make the puts 130 or $140 out of the money. Just use like the most simple math. Like what I'll do to find the strikes is I'll take like the 2220s. Whoops. Okay. So the 2220s, and I'll subtract where the SPX is, which is, you know, 2090. And that equals 130 points. Well, then I'll just basically do what? To find the put strikes? 2090 minus the 130 comes out to basically 1960. So that means if I'm going to sell the 2220s, means I'm probably going to sell the 1960s, and that's how I find the put spread. And I will say this. I sometimes do make a little bit of directional bias to my irons, but generally you should make them net neutral. You shouldn't have like that big directional bias. Okay. Somebody said, do you really trade one lot at a time? You're just suggesting that for beginners. No, sir. I really do trade one lots. I love trading one lots. I know that makes people totally nuts, but I like to, call myself Captain One Lot, especially in the SPX. The biggest change I've made in my own trading in the last 10 years. Okay, I have the luxury of sitting here throughout the course of the day. You got to realize a one contract iron can have $800 of risk, right? So I'll trade a one lot, and if I really want to do more than a one lot, I'll still route one contract. I'll just come back later in the day and do another contract. But yes, I really do trade one contract in the SPX at a time. And again, I'm speaking from experience. So for a period of about 4 years, I ran a registered investment advisory service. At that advisory service, we traded routinely over 1 million contracts a month. And at that time, I did not trade one contract at a time. We were trading routinely over 1 million contracts in a month. We would trade like ridiculous size. And, the thing I found out is in my own account, like I think more logically when I trade smaller. Okay, and there's times where it can be realistic. Sometimes I'm kind of pissed off because I'm like, damn, I didn't get that trade on enough. But I'm always happy when the volatility kind of hits the fan and I'm small. And that's just something that I want you guys to be aware of. All right, VIX okay to trade. I think the VIX is actually an extremely experienced trade. By the way, somebody said managing a lot of one lots is it's a little bit overwhelming. It really doesn't become overwhelming. Some of you will even progress to know how to read the Greeks, okay, and the entire position. And then you don't even have to look at the individual trades, okay? So, by the way, on the SPY, would I trade one lots? No. If I was on the Spider, I myself would not trade one lots. I think that the Spider is the greatest product for retail clients. It's like you traded for a year or two, right, or 18 months, and you still sometimes kind of need the training wheels on. The Spider is the greatest product. Like you still make good money in the Spider, but the Spider doesn't get all kinds of crazy when it hits the fan out there. And that's why I really do think that the Spider is the most retail-friendly product out there. It just is, okay? So how many would I trade on the Spider? The Spider depends on if I make it a $2 wide spread, a $3 wide spread, or a $5 wide spread. Okay, when I'm in the Spiders myself, I typically trade 5 lots. Okay, and 5 lot is, in theory, a 5 lot is about half the size of what I would trade in the SPX. That's just what I typically trade in the spiders. And I will say this, most of the stuff that I do in the spiders, okay, is really naked. So in the spiders, I have tendency to trade naked more than anything, and I'm comfortable trading naked in the spiders, and I'll do that because it's smaller contract size. Okay. By the way, somebody said, do you like the spiders, even though the taxes are higher than the SPX? Tax consequences over there, I've never let them impact my trade. Okay. I'll tell you when the spider is the greatest thing. The spider is the greatest thing. Okay. When markets get wildly volatile. And when the markets get wildly volatile, you're going to be like, man, the SPX becomes like this behemoth. When you go into a product like the spider, the exact same trades are applicable. I'll even go 92 days out in the spiders because the expiration just happens to be there. And inside the spiders, you're like, all right, it's a little bit more limiting though, because you're like this 9 delta. Okay. So then you kind of got cute. You sell these, then you turn around. What did I sell? I sold the 223s. And you have to make these spreads maybe a little bit wider to make it worth your while, because you don't want to just sell an option for 39 cents, right? Sell the 223s, okay? Then maybe have to buy the 230s. It's a $3 wide. So how far out of the money am I? I'm about $13 out of the money. So I'm going to go $13 out of the money in the put side. It's going to take me to the 197s, maybe 194s. Whole trades for an 85-cent credit. So what have I got over here? Okay? You've got to take the max loss here is what? It says $615 is the max loss. Well, it's a 3-contract trade, which you always need to figure out. Remember, you have $3 wide spread, okay? On a $3 wide spread. Okay, oops, apologize here. I actually slipped up on the upside. Okay, let me fix this. Are there strikes available for it? Okay, 24, 27. It's not traded in there. Okay. Challenging over here. So we actually got the strikes are ultimately not there right now in the spiders. So this is where, again, got to get a little bit more imaginative. Let me actually switch it up, okay, to make a little bit more effective trade. I'm going to stay in the 92-day expiration because I want to show you a significantly more challenging trade to be able to play, specifically in the spiders in this one. I'm going to have to go to the 223s. You can check the 225s. But that $2 wide spread, you're only collecting like an 18-cent credit on. $13 out of the money. Now I'll try the 97, for instance, 95s. Okay? This will actually play. Here's a $2 wide call spread, a $2 wide put spread for 53-cent credit. You'd easily execute this trade at 250, at 50 cents, which ultimately leaves you what? About $1.50 a risk. Take $1.50, take $1.50. And you divide it by $2, your probability in here could even be a little bit higher. This trade's got about a 75% probability. All I'm doing is just I'm ballparking trades. I'm throwing, trades at you as I'm going over here. The risk is about $1.50 in the trade, divided by a $2 wide spread, comes out to about 75% probability. Remember, you really want to be between what? 80, 90%. So what you can do is you can kind of fiddle around with the strikes a little bit. Things don't always work out perfectly in markets. It's a live market. You do what you can. Okay? What else could you do in here? Well, you could do the 225, 230. Okay? That's a $5 wide spread. Are you even going to collect enough credit? So let's actually show a slight variation here. Okay? Let's do the 225, 230. It's a $5 wide call spread. Now we're $15 out of the money. So I dropped this strike down to the 195, 190s. 51-cent credit on a what? $5 wide. Now you're actually taking, whoops, I apologize. Let me unlock this. It's an 86-cent credit. I knew something was off over there. Let's say you were capable of executing that trade at about an 85-cent credit. I think that's reasonable. This trade then has $4.15 of risk. Okay? On a $4.15 of risk on a $5 wide. So if you take the spread, okay, now you're taking roughly what? 415 divided by $5. Probability is 83. We're home. Okay? That's a decent iron inside of the spiders. What's going to be challenging is that the spiders are going to have to do what? They're going to have to make a decent sized move, okay, for you to be able to continue to allocate. And you're going to have to go out there and you're going to say, all right, I have a 92-day, or I can even sell a 57-day. you're going to have to give it a little bit more time, okay? Because again, you want to allocate irons that are 50 to 90 days out, and it's a little bit more limiting. So somebody that's trading in the spiders, what you probably want to do is allocate some to the spiders and consider allocating some to IWM, okay? Put yourself in two different products if you're not able to get enough allocations on. Hopefully that helps over there. All right. So what do you typically keep bailing out at 30 days? All right. I always bail at 30 days. I bail out at 30 days ultimately because I don't want to start incurring directional risks, no matter how sweet a trade may be, no matter how far away from the strikes. The most consistent thing is I pull out of the trade 30 days out because the directional risk you incur really grows drastically over there. You got to be aware of that. Okay, somebody said, Don, you showed a sizable SPX short position a couple of days ago. Can we take a look at the position tonight? I want to see how you constructed the trades. All right, so I have a gigantic short position on in my personal account, and I don't mind telling you guys this. So I have this gigantic short position, equivalent to spiders. I'm approximately short almost 3,300 spider deltas. I'm short, though, for a number of reasons. The trade I constructed, okay, happens to be simply short. I'm short the financials, and I'm using my short position also as a bit of a hedge. I happen to own a crapload of a brokerage firm that I used to work for. I own their stock, and I own it in a hefty manner inside of a 401k, and I'm hedging a little bit of it. And I'm hedging it using the XLF, and I'm hedging it using, competing broker-dealers out there, because while I worked for the firm, I was incapable of trading the firm's stock. I could only be long the stock, so I have a bit of a hedge position on there. Okay. All right. If you get a good vol crush, do you also get a reciprocal gamma threat? Volatility crush usually just leaves you with risks to the upside. Okay. All right. So as we're kind of wrapping up, wow, there's still a lot of questions in here, and hopefully I was able to answer the vast majority of them. I know for some of you guys, you're on the East Coast, it's 11 o'clock at night already. It's getting late over there. Again, it's kind of my first class over here. I guess it's trial by fire a little bit, and I hope you guys did enjoy it. I kind of feel like I really enjoy doing classes where a vast number of people can come to them. And instead of a class like, costing $3,000 or something like that, a class $100, one here, one there, you guys are going to learn a huge amount. And in these small, sessions, whether it's 2, whether it's 3 hours, including answering questions, we can get through so much. And there's only so much information you can really absorb, and pack it in over here. If you do have the means, next Tuesday, I am going to be firing trades like a madman. I'm excited about that. I'm actually more excited about that class than even the one I did tonight, because it's the first time I've ever really gotten to trade live in front of anybody. And it's something it's pretty near and dear to my heart, because a lot of the order routing stuff that we did, okay, the brokerage firm I worked for many years, a lot of the order routing stuff I did, we helped build a lot of that stuff. And I'm going to try to show you insight to exactly how your orders really route. Like, very few people know from the time you hit confirm and send what really goes on over there. Anyway, if you guys need anything, you can always reach me. I'm Don. This is a tough one. Don at simpleroptions.com. Don at simpleroptions.com. You can reach out to me anytime. I know there's one of me and there's like 1,000 of you guys. So again, thanks a lot everybody for joining me tonight. Have a great evening. Bye-bye.